Hello students, welcome back to another session of economics. To be more precise, from today on we'll be dealing with economics for finance, okay? Like we have completed your business economics chapters in a span of 1 hour, we are going to do the same in the case of economics for finance. So I'm going to take you through all the chapters of economics for finance. So what you have to do is you have to, stay put, you have to maintain a notes, you have to write down whatever we are teaching. So that will do the job for you. And with this knowledge, you will be confidently able to solve the MCQs. Okay. So with no delay, let us start the chapter. So the first chapter that we are going to start with is national income accounting. Okay. So we'll discuss about the key terminologies first. So in your key terminologies, the first terminology that you see is gross versus net. The first terminology that you see is gross versus net. Students, whenever you are encountering the term net, remember that it is used in two instances. Whenever you are encountering the term net, it is used in two instances. One is gross minus depreciation. The second is receipts minus payments. The second is receipts minus payments. So whenever you are seeing the term net, it is used in two instances. One is gross minus depreciation. The other is receipts minus payments. Okay. So what do you mean by gross minus depreciation? In that, what do you mean by depreciation? Depreciation is nothing but wear and tear. See, whenever you are using an asset, it is prone to what? It is prone to getting, obsolete. It is, wear and tear will keep happening. It will lose its value, right? It is not that whenever you buy an asset, it will have the same value till the end of the life. So when you minus the depreciation from gross, you will be getting the net value. Clear? So if you have to see the terms here, net is equal to gross minus depreciation. So you will be discussing the concepts of national income accounting in the later topic. Then I will be taking you through GDP, GNP, GNDI. All this I will be discussing in the coming topics. Okay. So let us see this. Depreciation is subtracted because capital wears out or depreciates. It is used in the production process. So whenever you are using the capital in the production process, it is subject to depreciation. Even asset obsolescence and complete destruction are considered by NDP or NNP. So people, whenever you are calculating depreciation, it also includes complete asset destruction as well, right? And in other case where you will be using net terminologies, you will be using net when we are talking about receipts minus payments. What do you mean by receipts? Whatever you are receiving, and payments is something that whatever outgoing is payment, incoming is receipt, right? So what are the things here? Example 1, net indirect taxes. So what do you mean by net? Receipts minus payment. So whatever the government is receiving, whatever the government is paying. Whatever the government is receiving is receipt. Whatever the government is paying is subsidies. If you take the government balances, taxes is something that the government is receiving. Subsidies is something that the government is paying to the people, right? So if you take indirect taxes minus subsidies, that is called as net indirect taxes. Next, what is this net factor income from abroad? But whenever you hear the term net, it is nothing but receipts minus payment. So what do you mean by factor income from abroad? Net factor income from abroad. That is nothing but receipts minus payment, right? Factor income from abroad minus factor income to abroad. See, whenever our people are working abroad, whatever money they are earning there, they will be remitting that back to India, right? So factor income from abroad. And whenever the foreigners are here in India, whatever money they are earning here, there is a possibility that they will send that to their home country. So it is factor income to abroad. So from abroad is we are receiving, to abroad is we are sending. So what is net factor income from abroad? Factor income from abroad, which is receipts, minus factor income to abroad, which is payments, right? Next, net exports. Again, net is nothing but receipts minus payments. See, whenever you export something, you're receiving money. Whenever you're importing something, you're paying money, right? So exports minus imports is nothing but net exports. What is this NCTROW? Okay, it is net current transfers from rest of the world. What is it? Net current transfers from rest of the world. See, what do you mean by transfer payments? It is one-way traffic. There is only incoming, but there is no outgoing. Okay. So what are transfer payments? It is only incoming, but there is no outgoing. So sometimes what happens is, you can take the recent example of Turkey, right? There has been an earthquake and many countries kind of donated money for the welfare of the people of the Turkey. So this is transfer payment. There is no productive activity, but still they have received money, right? So that is nothing but as transfer payments. So whenever the country is in trouble, it kind of receives money from abroad, okay. So they are called transfer payments received from abroad. And like other countries are helping us, we will also keep helping other countries, right? So whatever transfer payments you are making to other countries, it is transfer payments to abroad. Whatever payments you are receiving is transfer payments from abroad. So what is net? Receipts minus payments. So whatever you are receiving minus whatever you are paying. So as we have come across the word called as transfer payments, let me tell you students, there are three types of transfer payments. First of all, what are transfer payments? They are one-way traffic. There is only incoming, but there is no outgoing, right? So what are the three types of transfer payments? The transfer payments from government. What is it? Transfer payments from government, like unemployment benefits, pensions, all these are transfer payments from government, right? Next, interest on public debt. See, whatever interest payments that you are making on debt, it's considered to be transfer payments because it is not kind of, generating any economic activity as such. Next, transfer payments from rest of the world. Okay, transfer payments from rest of the world. See, whatever you are paying these interest payments on public debt, they are considered of revenue nature, right? They are not giving any benefit for you. See, whenever you take a loan, you kind of start paying this interest payments. Whenever you are paying the interest, are you getting anything in return? You are not getting anything in return, right? You are just paying the money, you are losing that out. There is no, benefit being generated from that interest payment. So interest on public debt is considered to be a transfer payment. The last thing that I talked about was transfer payments from rest of the world, right? Transfer payments from rest of the world is something that you're receiving from abroad, from other countries, right? So what are the three types? Transfer payments from government, interest on public debt, transfer payments from rest of the world, right? These are the things I wanted to discuss. The next key thing is domestic versus national. What is the next thing? Domestic versus national. See, you keep hearing the terminologies GDP, GNP, right? You keep hearing these terminologies called as GDP and GNP. See, whenever I am saying domestic, I am considering only the territory of my country. For example, I am saying domestic, right? So, whenever I am considering the boundaries of my country, it is called as domestic. If you add NFIA to domestic, it will become national. If you add NFIA to domestic, it will become national. See, the meaning of national is I want all my citizens' income to be included, whether they are staying in the country or whether they are staying anywhere else. If they are staying anywhere else and they are earning money, they are going to remit that money back to India, right? So it is my people's income. So whenever you are saying national, you are not worried about the boundaries, but you are only considered about the nationals of your country, the citizens of your country. But whenever you are saying domestic, you are only worried about the territory. You're only worried about the territory. Whenever the production activity takes place in your own territory, that is included in domestic. But in national, we are not including everybody's income. See, foreigners, even though they make the production process in India, there is a possibility that they will remit their money back to their own country. So I will not be including that income. But my citizens, when they are staying outside the country, even though they are earning it outside, they are my citizens. So they'll be remitting that money back to India. So I'll be including that in the national. So what is the difference, students? In domestic, you are worried about the territory. So whenever the production activity takes place between the boundaries of the country, within the boundaries of the country, whether made by a national, whether not made by a national, like a foreigner has done it, you still include that because it is in your territory. Domestic plus net factor income from abroad will give you your national. Domestic plus NFIA will give you your national. The difference between national and domestic is nothing but net factor income from abroad. What do you mean by net? Net is nothing but receipts minus payments. So the formula is factor income from abroad minus factor income to abroad. Next, national is equal to domestic plus NFIA. Next, domestic is equal to national minus NFIA. Simple math. You take the value that side. That's all. Next, NFIA is aggregate amount the country's citizens and companies earn abroad. So, what are they saying here? Countries, citizens and companies earning abroad. For example, if our companies are setting up branches abroad, the profits, whatever they are earning there, will be remitted back to the home country, right? So, they're taking companies, they're also taking individuals who are earning income abroad, which will be, sent back to the home country minus aggregate amount of foreign citizens and overseas company earn in that country. In India, if any foreign citizens or overseas companies are making money, they will be sending that money back to their own country. So that has to be deducted. right? Next, net factor income from abroad, another formula. See, these are nothing but different ways of expressing your net factor income from abroad. Factor income earned by domestic factors of production employed in the rest of the world minus factor income earned by the factors of production rest of the world employed in the domestic country. See, factors of production is what? Those who are included in the production process are nothing but factors of production. So, if the factors of production are earning something abroad, that will be bought back, so add it. And other countries' factors of production, if they are earning something in India, that will be sent back, so deduct that. Next, NFIA can also be written as, see, whenever you are seeing the net term, it is receipts minus payments. So, whenever you are encountering the term net, it indicates that receipts minus payment. Net compensation to employees. You all know that our people will be going to abroad to work, right? So, whatever compensation they are receiving, that is nothing but compensation to employees, nothing but wages, salaries, all that is compensation to employees. Next, you people not only go abroad to work, but there is also a possibility that you will be investing abroad, right? You will be investing money abroad, you will be buying properties abroad, right? So, net income from property and entrepreneurship. So, whenever you are investing money abroad, whatever money you have to receive, whatever money income you have to receive from the investments there is what? Receipt. And whenever other people invest in our country, they will be receiving some payments that will be paying them, right? That is payment. So, it has to be deducted. So, net income from property and entrepreneurship and net retained earnings. To understand this retained earnings, let us understand another terminology called as profits. Corporate profits. Okay. Corporate profits are made by business houses, right? This corporate profits has three terminologies included in it, which are corporate taxes. See, whenever a corporate house makes profits, it kind of pays its taxes out of the profits. A part of the profits is paid as dividends to the households. You all know that whenever you are buying shares of some company, you become a shareholder and you will be receiving something called as dividend, right? So, dividend are a part of corporate profits, and some portion you kind of keep it as retained earnings. That is, you will not be using it, but you will be keeping it aside for future purposes. So, retained earnings is nothing but the money that you are holding to yourself without paying as taxes or dividends, right? This is retained earnings. So, what do you mean by net retained earnings? Whatever retained earnings our companies have, that is our money. Whatever retained earnings other companies, foreigners have, that is their money. So, net retained earnings. It is also receipts minus payments, right? So, what are the elements included in corporate profits? It is corporate taxes, dividends and retained earnings. So, what is the formula for net factor income from abroad, students? Net compensation to employees plus net retained earnings plus net income from property and entrepreneurship. You not only give your labor, but also you kind of make some investments, right? So, whatever money you are receiving, add that. Whatever you are paying to other people, you just deduct that amount. Next, another important terminology that we have to take into consideration is resident versus national. Okay. See, whoever is having predominant economic interest is considered to be a resident. Okay. But whenever you are coming to national, you are not considering the boundary here. You are only saying that that particular person may have an economic interest within the country or outside the country. See, I am saying Indian national, right? He can have an economic interest within the country or outside the country. I'm not bothered like where he is having the economic interest. I'm only bothering about whether he is my citizen or not. So, the term resident in terms of domestic refers to unit having predominant economic interest in a country's economic territory for 1 year or more, irrespective of the nationality. That is what I am telling. If a foreigner is coming here, he is making some, he's indulging in some productive activity, he is called as a resident. He's having a predominant economic interest for more than 1 year. But when it comes to national, I'm not worried about like whether he's having predominant economic interest in my country or outside. I'm only worried whether he's my citizen or not. The term national is a broader concept compared to domestic, because you are not worried about the territory in your national, right? So it is a broader concept when compared to your resident or your domestic, right? Next. The next thing that you will be learning is indirect taxes. You keep hearing these terms called as direct taxes and indirect taxes, right? Whenever the burden of taxation can be shifted, that is called as an indirect tax. Whenever the burden of taxation cannot be shifted, that is your direct tax. Under your indirect taxes, you have product taxes, production taxes. You have product taxes and production taxes. See, during the production process, if anything is imposed, that is production taxes. After the production process is completed, the final product is made, then any imposition of tax is nothing but product tax. So you have got product tax and production taxes, right, everybody? Next, let us discuss some concepts called as factor price, basic price and market price. We are going to keep it very, very simple. Whenever you are saying factor price, it is nothing but the summation of the cost of production. So you have 4 factors of production: land, labor, capital, entrepreneur. So whatever your factor payments are for these 4 factors of production, if you sum them up, that is your factor price. For this factor price, if you are adding production taxes and deducting production subsidies, always remember students, taxes are to be added, subsidies are to be deducted, okay? That is your basic price. So in basic price, you are only talking about production taxes, production subsidies. But in your market price, you take both. You take both production taxes and production subsidies. So market price is nothing but basic price plus product taxes minus product subsidies. So what is it? Basic price plus product taxes minus product subsidies. So this is your market price. In basic price, you are only considering production taxes, production subsidies. In market price, you take into consideration both production related taxes and product related taxes, production related subsidies and product related subsidies. That is it. Okay. So can I write it as market price is equal to factor price plus net indirect taxes. This indirect taxes includes both production related and product related as well. So this was a small concept that you have to remember. So market price is equal to factor cost plus NIT. NIT includes indirect taxes minus subsidies. Whenever I am saying indirect taxes, it includes production taxes, product taxes as well. And when you are talking about basic price, you are only considering what? Production taxes, production subsidies. Okay. So that is what you have to remember. In basic price, you are only talking about production tax, production subsidies. So this is a small concept. Do remember, students. The next thing is national income. See, whenever you say national income, it is nothing but the final value of all the goods and services produced within the domestic territory, and if you add NFIA to it, it will become national income, right? In India, your national income is measured at NNP at factor cost. Our national income other name is NNP at factor cost. This we will be discussing in detail when we are talking about your concepts of national income accounting, okay? So here we are going to discuss some memory based question for you. So please pay some close attention. So what is the introduction? Nobel Prize winning economists Simon Kuznets and Richard Stone introduced national income accounting as macroeconomic accounts from production stage to disposal stage. See, you have got 3 stages, right? First thing is you have to produce. Next thing is what? Next thing you have to distribute, and the other thing is the final consumption. So what are the 3 stages? First stage is production, second stage is distribution, and the third stage is final disposal, right? So these are the 3 stages. And who introduced this national income accounting? Simon Kuznets and Richard Stone. Next, in national income account, what we do is we first define the concepts. See, in the later topics I told you, right, we will be discussing the various concepts of national income accounting, and then we will construct the measures corresponding to these concepts. The second is help us understand how the various transactions are interrelated. See, I have discussed 3 stages, right? Your production stage, your distribution stage, and your consumption stage. All these 3 stages are interrelated, right? So we are going to understand how these are interrelated. Next, give us an idea about the working of the economy. So you will be able to understand the contribution of various sectors, what is the value of goods and services produced in an economy. So you're going to understand, you're going to get an idea with regard to economy or what is happening in your economy. Next, helps us to meet the needs of the government. See, why is the data required for the business analysts or the government to formulate policies? Obviously, when private people want to invest somewhere, they have to get, get their hands on some data, right? Like what is the position of Indian economy? How much is it making? Which sector is growing? Which sector is not growing? And the government will get to know where do we have to focus? Which sector has to be given, privileges? All that can be understood only we have the data availability, right? Next. So measurement of national income accounting. So who does this job? Who does the measurement of national income? See, at the central level, you have an organization called as Central Statistical Organization, and this CSO comes under Ministry of Statistics and Program Implementation. In short, it is called as MOSPI. I guess you all know about it. So at the central level, who does the compiling of national income? It is done by Central Statistical Organization, and your CSO comes under whom? It comes under MOSPI, Ministry of Statistics and Program Implementation. At the state level, who does the job? It is done by State Directorate of Economics and Statistics. State domestic product. Okay. Regional accounts. What do you mean by regional accounts? See, example is your net state domestic product. Okay. So it is nothing but your net state domestic product. Whenever I say that GDP, it is the GDP of the entire nation. Whenever I say state GDP, that is considered to be regional accounts. Like what is the GDP of Andhra Pradesh? What is the GDP? What is the state GDP of Karnataka? So this is regional accounting, right? Next, who does this? It is done by State Directorate of Economics and Statistics. Do remember this. Next, state income or net state domestic product. Money value or the volume of all the goods and services produced in the state within a year without duplication. That is, you should not re-record the transaction. That kind of overstates your income, right? So whenever you are talking about the income of one particular state, it is the NSDP or the net state domestic product. State level estimates are prepared by whom? State Directorates in Economic Statistics. We have just seen that. Next, CSO assists the states. See, CSO is on the top. State level accounts are prepared by the state directorates, but whenever these state directorates are in requirement of some, techniques or how to do it, your CSO kind of provides an assistance for that, right? So these are the things you have to remember with regard to your measurement of national income in India, okay? And you also encounter another term here called as supra-regional sectors. What are they? Supra-regional sectors. See, whenever the service is spanning across the area, whenever it is not restricted to one particular area, but it is spanning across the areas, it is called as supra-regional sector, okay? So, in preparation of the state income estimate, certain activities like railway, communication, banking, you know that these services are not restricted to one particular area, right? They span across the areas. So, cut across the state boundaries, and their economic contribution cannot be assigned to one particular state. When one particular service is not restricted to one particular area, you cannot restrict to that particular state, right? It is spanning across the boundaries. So, what is done is all this income, whatever is being collected is, sent to the center, and then center will allocate the money to the states. The center will allocate the money to the states in the required proportion. So what is the formula for per capita income, students? It is national income divided by population. What is the formula? National income divided by population. Here the things that you have to remember is at the center level, who compiles the data? CSO. At the state level, you have the state directorates. These state directorates are assisted by the CSO if there is any requirement. And please remember this term called as supra-regional sector. That is those sectors, like those kind of operations whose operations span across the areas. They are not limited to a specific boundary or specific area. Next, let us discuss what is called as gross domestic product. Your gross domestic product is also called as GVA or nominal GDP or GDP at market price or GVA at market price. Most students have this question that what is the difference between GDP and GVA? Okay, so GDP is nothing but what the final value of all the goods and services produced. But GVA kind of gives you a picture of what is the contribution of each sector. So this is production side, this is consumption side, okay. GDP kind of gives a picture from the consumption side. GVA gives a picture from the production side, like what is the contribution of primary sector, what is the value addition made by the secondary sector, what is the value addition made by the tertiary sector. So GVA is talking about the supply side. GDP is talking about the demand side. That is the difference between GVA and GDP, but both are used synonymously, okay. Next, so what is the formula for GDP at market price? Do remember this. It is value of output minus intermediate consumption. And whenever I say value of output, it includes sales plus change in stock. What is sales plus change in stock? Sales plus closing stock minus opening stock. What is change in stock? Closing stock minus opening stock. That is, I am only considering what is the amount of output that is produced in this particular year. I don't want what is produced in the previous year. You know that whenever something is not sold, it is carried forward to the next year as what? In this year, it will become your closing stock. In the next period, it will become your opening stock. So what am I doing here? I am deducting my opening stock because this is related to the previous year. I only want the current year information, like whatever that I have produced in the current year. So it is sales plus change in stock minus intermediate consumption. See, whatever you are using in the production process to produce that final good, that is your intermediate consumption, that is deducted. In your GDP, you are only taking the final value of goods and services. Those goods which are used in the production process, that is not taken into consideration. So, value of output minus intermediate consumption. When somebody asks you why you are deducting, because you are only taking the final value of goods and services, you don't want any duplication to happen. So, intermediate consumption you are ignoring. So, in intermediate consumption, we are talking about the raw material or inventories that are used in the production process, right? And this intermediate consumption, as you are only taking into consideration the inventories or raw materials that are being used in the production process, you don't consider depreciation intermediate consumption, okay? Depreciation is related to what? Assets, okay? That is not taken in intermediate consumption. In intermediate consumption, I am only talking about the inventory that is being used in the production process. Depreciation is calculated on what? It is calculated on fixed assets, okay? That treatment is different. So, don't include depreciation. Don't tell me that, madam, see, depreciation is what? You are using the asset. So, the machine is depreciated. It is also wear and tear. As this is also used in the production process, we will include this also. No, that treatment is different. So, for the formula of GDP is GDP at market prices, value of output minus intermediate consumption. What is value of output? Sales plus change in stock. What is change in stock? Closing stock minus opening stock, right? Next, let us discuss another concept called as nominal GDP and real GDP. In economics, you have called as concepts called as nominal GDP and real GDP, okay? So, what is real GDP? Whenever you are deducting inflation from your nominal GDP, that is your real. Okay, in economics, whenever you encounter terms called as real, it indicates that they are not including the component of inflation in them, right? So, for example, I'll take 2 years, 2021 and 2022. Okay, 2021 and 2022. And let me take that price quantity, okay? So what happened here was the prices in 2021 were some 100 rupees and the quantity that you produced was 1000 units. The prices in 2022 were, let us say, 150 rupees and the quantity that you produced was 1000, okay? So how will you calculate the GDP? Now, the final value of goods and service, right? How will you get the final value? Price multiplied by quantity. So, what is the value of your GDP in 2021? It is what? 1 lakh. What is the value of GDP in 2021? It is 1 lakh. What is the value of GDP in 2022? 1 lakh 50,000. Now, I want to know whether the value of GDP in 2022, which I am encountering to be 1 lakh 50,000, it is a nominal increase or real increase. What do you mean by nominal increase? If any increase in the GDP takes place due to rise in the prices, it is called as nominal increase. But if the increase takes place due to increase in the production activity, that is called as real increase. If you see with your naked eye, you can understand that in 2021 also my production was 1000. In 2022 also my production was 1000. So is there any real increase that you are seeing here? There is no real increase. See, whatever increase that you are seeing from 1 lakh to 1 lakh 50,000, it is due to increase in the prices. It is due to increase in the prices. So as there is no real increase, I cannot call it as rise in the real GDP, but I will only call it as rise in the nominal GDP. Now, what I will do is I will calculate real GDP for 2022. Whenever I multiply current year prices with the production, it is nothing but nominal GDP. Whenever I multiply my current year production with the base year price, what is your base year? I am taking 2021 to be my base year. Students, always remember that whenever you are calculating real GDP, you consider base prices because you don't want to take into consideration the component of inflation, because that is not giving you the real picture if in reality the number of goods and services you have produced has increased or decreased, right? So what I did was, the 2021 price that you are seeing here is my base price. So what I will do, I will multiply my current year production with the base price. What is my base price? It is 100. So 100 multiplied by 1000 is 1 lakh. What is my nominal GDP? It is 1 lakh. What is my real GDP? It is 1 lakh. So what does this indicate? There is no increment. There is no increment in the production. So that is the reason why your real GDP is constant. So it is indicating that you have not produced any additional goods and services, right? So let us write another formula. You have a concept called as GDP deflator. You have a concept called as GDP deflator. So what is the formula of GDP deflator? See, GDP deflator kind of eliminates the inflation component. See, what is the meaning of deflator? You're kind of, reducing the impact of something, right? You're deflating something. You're reducing the value of something. So the formula is nominal GDP by real GDP, right? So how do you calculate nominal GDP? Let us take like this. P1 is the current year price. Q1 is the current year quantity. P0 is the base year price. Q0 is the base year quantity. Okay. So how do you calculate your nominal GDP? Current quantity Q1 multiplied by current price. How do you calculate real GDP? Current year quantity. This is real GDP of 2022, nominal GDP of 2022, real GDP of 2022. How do you calculate real GDP? Real GDP is calculated at base prices. Real GDP is calculated at base year prices, right? So it is Q1 multiplied by P0. So your current year quantity, you are multiplying with the base year prices to understand if there is any increment in the output or not. So what will happen to Q1? It will get cancelled. What will you get? P1 by P0 into 100. Okay, this is into 100. Just write down P1 by P0 into 100. See, P1 by P0 into 100 is measuring what? It is measuring inflation. What is it called as price index? I hope you all are aware about it. P1 by P0 is nothing but your price index. So you are comparing P1 with the base year price. P1 is the current year price. P1 is compared with the base year price, and it will tell you the amount of inflation that is there in the economy. So this is nothing but your price index as well. GDP deflator is also called your price index, right? So this is talking about the amount of inflation. Next. So let us see the concept. Real GDP or GDP at constant prices. This constant prices is also called as base price. Constant prices are also called as base price. Sum of the quantities of final goods times the constant prices. Constant prices is nothing but the base year price. In our example, 2021 is the base year price. So I am multiplying my current production with the base year price to know the value of real GDP. Excuse me. To measure the change in the production over time, it must eliminate the effect of increasing prices. So if you want to really know the impact, whether you want to know really the GDP has increased or decreased, you have to eliminate the impact of prices, right? You have to eliminate the component of inflation. So what is the formula for GDP deflator? It is nominal GDP by real GDP into 100. So what did they explain about GDP deflator? The calculation of real GDP gives us a useful measure of inflation known as GDP deflator. That is, it measures the change in the prices. People, I have written the formula earlier also. So what is it doing? It is also called as price index because it is measuring the amount of inflation. GDP deflator also used to deflate or take the inflation out of GDP. So GDP deflator can be expressed as nominal GDP by real GDP. So what is your nominal GDP? P1 multiplied by Q1. What is your real GDP? P0 multiplied by Q1 into 100. So it will sum up to be P1 by P0 into 100. So it is nothing but your price index. So they have written it here. Price index. Price index is nothing but your GDP deflator, people. Don't get confused. So how can you write your nominal GDP? Nominal GDP is nothing but your GDP deflator or price index multiplied by real GDP. That's it. This formula you can, interchange, and then you can do a number of things with it. You can calculate nominal GDP using it. You can calculate real GDP using it. Your wish. Now, what they did in your exam was they have given the GDP deflator of 2 years. They have given the GDP deflator of 2 years, GDP deflator of year 1, GDP deflator of year 2. Now they are asking you to calculate the inflation rate. What did they do? They have given the GDP deflator of 2 years, and now they are asking you to calculate what? They are asking you to calculate the inflation rate. So what is the formula? You all know that it is nothing but new value minus old value divided by old value into 100. Inflation and rate is nothing but, see, compared to year 1, in year 2, was there any increment in the prices? So that is the inflation rate, right? Rise in the general price level. So how do you do that? GDP deflator in year 2 minus GDP deflator in year 1 divided by GDP deflator in year 1 into 100. That is the formula for inflation rate. When will you use this? When they have given you the GDP deflator of 2 years, you are going to use this formula, right? Next, let us understand GDP at factor cost. Students, what I am going to do right now for you is, before going to these concepts, let me write down something for you and make these things easy. We are actually, discussing the concepts of national income accounting, right? So let me write down some key terminologies for you again. So when do you say the value is net? It is gross minus depreciation. It is gross minus depreciation. Okay. Market price is nothing but factor cost plus NIT. Factor cost is nothing but market price minus NIT. Are you understanding what am I doing? Yes. So these are the things. Domestic plus NFIA is equal to national. Domestic plus NFIA is equal to national. These three things you have to remember to play with the concepts of national income accounting. So what did I write down first? I have given you GDP at market price. I have given you GDP at market price. Now what am I doing is, I am asking you to convert this into NDP at market price. I am asking you to convert this into NDP at market price. Now what you have to do is, you have to compare the letters here, okay? Gross, net. So there is a difference here. You have to adjust G for G so that it can become net. Yes, remember that. Domestic, domestic, same. No adjustment required. Market price, no adjustment required. So how will you get NDP at market price from GDP at market price? You have to deduct depreciation. So GDP at market price minus depreciation is equal to NDP at market price. You all know that gross minus depreciation is nothing but net. Let us do another thing. Suppose you are given GDP at market price and you are asked to convert this into NNP at factor cost. You are asked to convert this into NNP at factor cost. So what is the difference? Here it is gross, here it is net. So from gross, if you have to get net, what should you do? You have to deduct depreciation. Here it is domestic, here it is national. So from domestic, if you have to get national, what should you do? You should add NFIA. Next, here it is market price, here it is factor cost. So from market price, if you have to get factor cost, what will you do? You will deduct minus net indirect taxes. So this is your formula. So what did we do here? We have compared the letters. We learned 3 basic formulae, and from that we are playing with concepts of national income accounting, right? So let us see the next concept. What did they give for you? Yeah, they are talking about GDP at factor cost. Earlier, what did you talk about? You spoke about GDP at market price. So if you want GDP at factor cost from GDP at market price, how will you do it? Market price, factor cost. The remaining all are same. So from market price, if you have to get factor cost, you have to minus net indirect taxes. Yes, this is one formula. This is one formula. Another formula that you can write down is, I'm just writing this down for you. You just say if it is correct or not. What I can write is NDP at factor cost plus depreciation. Can I write it this way? Is equal to GDP at factor cost, right? So if for net, if you add depreciation, that will become gross. So if I write down NDP at factor cost plus depreciation, that is nothing but GDP at factor cost. So what is the meaning of NDP at factor cost? NDP at factor cost is nothing but the factor payments that you are making for factors of production. NDP at factor cost is nothing but the factor payments that you are making for factors of production, right? So what are your different factors of production? Land, labor, capital, entrepreneur. For labor, what will you be paying? You will be compensating them for their skill, right? So it is nothing but compensation to the employees. Whenever I am saying compensation to the employees, that includes salaries, wages, it includes what? It includes cash in kind and also cash. Okay, so you can also give it in terms of some benefits, allowances, that also can be considered as compensation to the employees. Okay, next, operating surplus. The meaning of operating surplus is rent plus interest plus profit. What is the meaning of operating surplus? It is rent plus interest plus profit. Rent is paid to whom? Land is paid rent. Interest is paid to capital. Entrepreneur is paid profit. So I have taken all the four factors of production: land, labor, capital, entrepreneur. For labor, you are paying what? Wages and salaries. That is nothing but compensation to employees. And for land, you are paying rent. For capital, you are paying interest. And for entrepreneur, you are paying profit. So all rent plus interest plus profit together, these three words are called as operating surplus. You are introduced with another term called as mixed income of the self-employed. You are introduced with another term called as mixed income of the self-employed. Who are self-employed? Entrepreneurs, like who are doing their own business without work, who are not working under somebody else, are self-employed. See, the problem with the self-employed is they are using their own resources in the business. They may be using their own land, they may be using their own manpower, everything. But are they being paid wages, rent like that separately? No. They are only paid something called as what? Profit. If they get profit, they will get it. So the problem what we encountered was we are unable to differentiate what is the amount of rent, what is the amount of wage, what is the amount of interest in the case of self-employed people. That is the reason we have introduced the category of mixed income of self-employed. So whoever is, finding their own occupation without working under somebody else, we categorize them under mixed income of self-employed. So compensation to the employees plus operating profit plus mixed income of the self-employed. Till here, you call it as NDP at factor cost. Okay, compensation to the employees plus rent plus interest plus profit plus mixed income of the self-employed. All these are nothing but factor payments, right? So all the factor payments together, they are called as NDP at factor cost. So NDP at factor cost is nothing but the summation of the factor payments. So if you add depreciation for that, it will become GDP at factor cost. It will become what? It will become GDP at factor cost, right? So the next concept that you see here is GNP at market price. See, above what did we get? We got GDP at factor cost, right? So if you want to convert GDP at factor cost into GNP at market price, how will you do it? You have GDP at factor cost. You are planning to convert that into GNP at market price. You are planning to convert that into GNP at market price. Gross, they are same. If you have to convert domestic to national, you have to add NFIA. Next, if you have to convert factor cost to market price, you have to add net indirect taxes, right? This is one way you can do. What is the other way? GNP at market price is equal to GDP at market price plus NFIA, net factor income from abroad. Gross similar. National, you have to, you have from domestic, you need to get national. So what did you add? NFIA you have added. Market price is similar, right? So this is how you convert. Please remember the three mantras, that is gross minus depreciation is net. Next, indirect taxes minus subsidies is net indirect taxes, that you all know. But factor cost plus NIT will give you your market price. Another thing that we discussed was domestic plus NFIA is equal to national. If you remember these things, these three things, you will be able to do the what? Conversions. Next, the market value of what is GNP? The market value of all final goods and services produced within the domestic territory. It is adjusted for what? It is adjusted for net factor income from abroad. So GNP is the total income earned by the nation's permanent residents. So we are only talking about nationals here. We are not talking about, foreign residents. Next, GNP differs from GDP by including the income that our citizens earn abroad. So what am I talking about? Whenever I say national, I am considering my citizens. See, I am not taking into consideration the income that is earned by foreigners. I will deduct that income. I will add, see, my nationals can be staying anywhere in the world. So anywhere they are staying, that money I will take into consideration because they are my citizens. Next. So let us see this. If NFI is positive, what will happen? So you have two concepts, right? You have GDP, you have GNP, right? GDP plus NFIA is nothing but your gross national product, right? So for example, if NFIA is positive, when will NFIA be positive? If your receipts are more than the payments, NFIA will be positive. If your receipts are less than the payments, NFIA will be negative. So if NFIA is positive, then what will happen? Your GNP will be greater than your GDP. What will happen if your GNP will be greater than your GDP? What will happen if NFI is negative? Your GDP will be greater than your GNP. Your GDP will be greater than your GNP. Next concept is NDP at market price. How will you derive? This is your GDP at market price. If you minus depreciation, that will give you your net value. So gross minus depreciation is nothing but net domestic product at market price. Next, NDP at factor cost. So how will you derive that? You have NDP at market price. If you want factor cost, you have to deduct net indirect taxes. People, what is the formula of NDP at factor cost that we learned? NDP at factor cost is nothing but what? Compensation to the employees plus operating surplus plus mixed income of the self-employed. That is the formula for NDP at factor cost, right? So do you remember that? If you add NDP at factor cost, if you add NDP at market price and if you deduct net indirect taxes, you will be getting your NDP at factor cost. If I have to repeat this for you, this is a direct formula which we have learned earlier, right? NDP at factor cost is what? Factor payments that are being made to the factors of production, which are your land, labor, capital, entrepreneur, right? So which is compensation to the employees, rent plus interest plus profit. All these three terminologies together will be called as operating surplus plus mixed income of the self-employed. That is NDP at factor cost still there. That is a direct formula. But what is the other way you can write NDP at factor cost? It is nothing but NDP at market price minus net indirect taxes. People, from market price, if you deduct net indirect taxes, it will become what? It will become factor cost. Next, NNP at market price. So it can be written as GNP at market price minus depreciation. Gross minus depreciation is net. Yes. So that is what they have done here as well. Next, NNP at factor cost or national income. Very, very important. Your national income is also referred to as your NNP at factor cost. So for example, I have given you GDP at market price. I am asking you to convert this into NNP at factor cost. Please pay close attention here. Here it is gross. I want net. What is it that I want? I want net. So what will you do? You will deduct depreciation. Next, here you are having domestic, but what do I want? I want a national. So what will you add? You will add NFIA, net factor income from abroad. Here what do you have? You have market price. What is that I want? I want factor cost. So you have to deduct net indirect taxes. This is how you do it, right? So net national product at factor cost or your national income. It is the factor income accruing to the normal residents of the country during a year. It is the sum of the domestic factor income and NFIA. What is domestic factor income? It is NDP at factor cost. What is domestic factor income? It is NDP at factor cost. If you are adding NFIA to this, it will become NNP at factor cost, right? Next, generated within the country plus factor income from abroad in an accounting year. It includes earned income only. Very, very important. See, whenever you are calculating your national income, you don't take into consideration transfer payments, my dear. In the beginning, while we started the lecture, I discussed something called as transfer payments, right? It is one-way traffic. There is only incoming. You are not doing any productive activity, but still you are receiving money. That is what unearned income. That is your unearned income. So I don't take into consideration unearned income while I am calculating my national income, right? So while calculating your national income, please do consider only your earned income. That is something you are earning for productive activity. Something that is not earned out of productive activity is considered to be transfer payment. It is not included in the national income. Next, you have your concept called as personal income, private income, which is very, very important. Most students, I don't know why, but they feel confused with this private income and personal income. Don't worry, in your lecture we will solve that for you. We'll have a discussion on your private income, personal income. We will be also doing some problems so that you will not have any future confusion. Okay, so what we will do is we'll start discussing your private income, personal income. Friends, welcome back. So in the last session we have completed the concepts of national income, right? So if you want a brief revision on the concepts of national income accounting, I told you to remember those three mantras. What are those three mantras? I told you that whenever you are hearing the term net, it indicates that it is gross minus depreciation. It is gross minus depreciation. And whenever you are hearing the term national, it is nothing but domestic plus NFI. Whenever you are hearing the term national, it is nothing but domestic plus NFI. What is NFI, students? It is net factor income from abroad. That is factor income from abroad minus factor income to abroad. What does that mean? It means receipts minus payments. Okay. And what else do you have to remember? You have to remember that factor cost plus net indirect taxes is equal to market price. What are net indirect taxes? It is nothing but indirect taxes minus subsidies. Clear, everybody? So if you remember these three things, you can do the concepts of national income accounting. Now, if we have to continue our discussion, we need to discuss about your personal income and private income. You all know that in national income accounting, we do not consider transfer payments. Now, what are transfer payments? To help you revise the thing, transfer payments are nothing but one-way traffic. Okay, they are not, given out of some productive activity. For example, you can take your scholarships, you can take the unemployment benefits. All these come under your transfer payments, donations, etc. So we have three types of transfer payments, right? What are the three types of transfer payments, may I know? They are transfer payments from government, transfer payments from rest of the world, and interest on public debt. What are the three types of transfer payments? Transfer payments from government, transfer payments from rest of the world, and interest on public debt. Okay, so this interest on public debt is a revenue expenditure. Okay, it is not yielding you any result, which is why it is considered to be a transfer payment. So whenever you are doing the national income accounting, whenever you are discussing the concepts of national income accounting, we have not taken these three things into consideration, right? So what you have to do right now is, while you're calculating your personal income or private income, you need to include transfer payments. That is, all these three transfer payments have to be taken into consideration. And we all know that there are three agents, which are households, business firms, and the government. These three constitute our economic agents, right? Whenever you are talking about the income of households and business firms excluding the government, it is called as private income. It is called as private income. Okay, and whenever you are only talking about the income of the households excluding business firms and government, it is called as personal income. So in personal income, you only have the household's income and the transfer payments, but in private income, you have the household's income and business firm's income, which is excluding the government income. Okay, so these are the things you have to remember coming to your personal or private income. What we will do right now is, we'll first have a look at your private income and then we will proceed to your personal income. So let us see the points. Yes. So yeah, first we'll have a look at your private income, students, then I'll take you to the personal income, because private income is households plus business firms, right? So after calculating private income, if you just deduct business firms, that will be getting you your personal income. So let us see your private income. Where is it? Yeah. So what is private income? It is nothing but it is a measure of income, both factor income and transfer income. Do you see this? That is what I have been trying to tell you. While calculating your personal income or private income, you have to take transfer payments into consideration. And how many types are there? Three types of transfer payments have to be taken into consideration, right? Which accrues to private sector. What do you mean by private sector? It includes households and business firms. So what is the formula for private income? It is the factor income from NDP accruing to the private sector. Again, private sector includes households plus business firms, plus net factor income from abroad. Why are they doing this? See, till here what did you get? You got NDP at factor cost. Now if you have to transform NDP into NNP, that is, domestic has to be transformed into national. Domestic has to be transformed into national. How will you get national? National is equal to domestic plus NFIA. National is equal to domestic plus NFIA. So, you have to add the net factor income from abroad. National debt interest or interest on public debt is one and the same. So, what is this? It is transfer payments. Transfer payments from government and transfer payments from rest of the world. That is what I have been trying to tell you. So what did you do in your private income calculation? You took the income that is accruing only to the private sector, that is your households and business firms. As it is NDP at factor cost, you wanted to transform it as NNP at factor cost because we want national, right? So you have added NFIA. For that, you have added all the three types of transfer payments, that is interest on public debt, transfer payments from government and transfer payments from rest of the world. What is the other formula for your private income? It is nothing but national income minus. See, whenever I am saying national income, it is nothing but NNP at factor cost. Whenever I am saying NNP at factor cost, it is including all the three economic agents. It is including all the economic agents, that is households, business firms and government. Now, it is your responsibility as you are calculating private income, you have to deduct the government income. So, whatever money income that is accruing to the government sector, that has to be deducted. Government income also includes the non-departmental enterprises. What does it include? Savings of the non-departmental enterprises. Okay, so non-departmental enterprises are nothing but those which not come under a certain department or a particular department. Example, you can take this ONGC, you can also take the RBI. So whatever savings that are being accrued to the non-departmental enterprises, that is also government income. You know that RBI is a fully owned government body. So whatever savings that RBI does, whatever money income that RBI has, like it is given in the form of dividends to government of India. So that also has to be taken into consideration. And while calculating your private income, you have to deduct that. You have to deduct that, right? So it is national income minus income from domestic product accruing to government sector. So accruing to government sector also includes savings of non-departmental enterprises. People, you will be encountering this term while you are doing the problem. So please take a note of it. So what is the savings of non-departmental enterprises? Even they have to be deducted from your national income while you are calculating your private income. And in your national income calculation, did you take into consideration transfer payments? You have not taken into consideration transfer payments. Transfer payments are again three types. So all the three types of transfer payments have to be added, right? This is the formula for your private income. And what else can be done for the calculation of private income? It is nothing but personal income plus corporate tax plus undistributed profits. How did we arrive at this? Okay, let me just help you out with this. I already told you that whenever you are talking about personal income, it is only taking into consideration households. So whatever income that is being accrued to households plus transfer payments is nothing but your personal income, right? So you remember corporate profits? Corporate profits. This is something that is accruing to the business firms, right? Corporate profits include three things. Corporate profits includes three things. What are those three things? One, you can pay corporate taxes. Corporate taxes. Next, dividend is paid out of it. Next, something is called as retained earnings or undistributed profits. Okay, what are the three components? They are corporate taxes, dividend, retained earnings or undistributed profit. Okay, so out of the corporate profits, whatever you are earning, some is paid as corporate taxes, some is paid as dividend and some is put aside as retained earnings. Now what is the only thing that is going to household in all these three things? It is only the dividend that is going to the households. It is only the dividend that is going to the households, right? So these two things, which are corporate taxes and undistributed profits or retained earnings, are not taken into consideration while you are calculating your personal income, right? So these two things are a part of what? Corporate profits. Corporate profits belongs to whom? Business firms. So when you calculate your personal income, for that, if you add this corporate taxes and undistributed profits, that will become your private income. Okay, so that will become your private income. Transfer payments you already included while you are calculating the personal income, so you don't have to include them again. So whatever you have deducted from the private income, as it is not a part of your personal income, that if you add back, it will become your private income. So I hope you understood. So the key things that you have to remember about your private income is that it is being accrued to households and business firms. In national income accounting, you are not taking transfer payments into consideration. So you have to add transfer payments while you are calculating your personal income and private income, right? Next, let us discuss your personal income. Okay. Yeah. So this is your personal income. Income received by household sector. What are they saying? The income accruing to the household sector is considered as your personal income, including non-profit institutions serving households. You know, the NGOs, they kind of perform some functions for the households. So whenever they are rendering some services to the households, that also has to be taken into consideration while calculating your personal income, right? Next, it forms the basis for consumption expenditure and is derived from national income. So how are you deriving your personal income? You are deriving that from your national income. So in your national income, you have your business firms, you have your households, you have the government. If you eliminate your business firms and government, you will be left with whom? Households. If you add transfer payments to that, what it will become? It will become your personal income. So personal income is nothing but national income plus income received but not earned minus income earned but not received. See, the simple meaning of this is, while calculating personal income, you are only focusing on the households. While calculating personal income, you are only focusing on the households, right? While calculating national income, you only take into consideration those activities which are productive in nature, okay, which are productive in nature. You do not take into consideration transfer payments. For example, the households are working somewhere and they have received the salary. But do they receive the entire salary? No, right? Some portion is cut in the form of PF or whatever it is. So some portion is cut. Whatever portion they are not receiving, I am not taking that as a consideration for calculation of personal income. I am only taking into consideration whatever I am receiving in my hand. That only has to be taken into consideration while calculating personal income. So even though you earned that income, but still if you are not receiving it, I am not going to take it into consideration while calculating personal income. So I only take into consideration those things which are actually touching my hand, which are actually, you know, in which I'm actually getting. So if you take unemployment benefits, for example, you are not doing anything, but still you are receiving the money. As you are receiving the money, even though you have not worked hard for it, I am taking into consideration while calculating the personal income. Okay. So income received but not earned is what? Transfer payments. Example, your scholarships, pensions, your, you know, unemployment benefits, all that can be taken as an example for your income received but not earned. What is income earned but not received? See, you worked a lot for the organization, but the organization is, you know, retaining some money and paying the remaining to you. So whatever retained earnings are there, I have told you, right, corporate profits is split into corporate taxes, dividends and retained earnings. Retained earnings, are you getting that money? It is not, you know, given to you. It is retained with the company. It is held by the company. As you are not getting that, will you include that while calculating the personal income? No, you will not take that into consideration while calculating personal income. So retained earnings are not taken. Indirect business taxes. See, corporate taxes are they being given to, I mean, are they giving that to you? No, you are not receiving those corporate taxes, right? So that also we don't take into consideration. Corporate income taxes and contribution of the employers to social security. So any social security contributions like your provident fund contribution, that is also not taken into consideration while calculating your personal income, because even though you earned that money, you are not still receiving it, right? While calculating personal income, I only take the money that has been received, right? So personal income is national income minus undistributed profits is nothing but your retained earnings. As households are not receiving that, I am going to deduct that. Next, net interest payment made by the households. See, whenever you are encountering the term net, it includes receipts minus payments. Whenever you are encountering the term net, it means receipts minus payments. See, households make some interest payments, household receives some interest payments. So the net amount is kind of, you know, taken into consideration. Here they said minus. What is the meaning that you're deducting things? That is, whatever is outgoing is more when compared to whatever is incoming. So receipts minus payments, right? If payments are more than receipts, the value will be negative. If receipts are more than payments, the value will be positive, right? Minus corporate taxes. This is not something that is, going to households. So I will deduct this. Transfer payments, all the three types. Transfer payments from government, interest on public debt, and transfer payments from rest of the world. All these three things have to be taken into consideration, right? So interest on debt anyway is kind of taken into consideration in this point. Net interest payment made by the household is nothing but interest receipts by the households minus interest payments by the households. So whatever remaining transfer payments are there, they have to be taken into consideration here, right? So both firms and government, they are giving some money, right? So that has to be taken into consideration. Next, so they have explained the net interest payment made by households to firms and government. Households receive interest payments from firms and governments. They also make interest payments to firms and governments. So I told you, right, it is receipts minus payments. Now let us continue with something called as disposable income. See, whenever you hear the term disposable income, it indicates that you are adjusting with taxes. So you calculated personal income, right? So if you minus taxes, personal income minus taxes is nothing but disposable income. What is it? Personal income minus taxes is nothing but disposable income. That is, which is readily there with you to spend. So disposable personal income is derived by subtracting direct taxes paid by individuals and other compulsory payments made to the government from the personal income. That is, it is minus personal income taxes. So whatever money you are left with right now, they can be used for consumption purpose or they can be saved. So it is disposable personal income is equal to C plus S. Like some money can be used for consumption purpose and the remaining can be saved, right? Next. What is net national disposable income? Let us see this. What is net national disposable income? So, it is the net amount of goods and services the domestic economy has at its disposal. See people, whenever I am saying net national disposable income, I am talking about at a national level, right? So, here it is net national income, right? So, this is NNP at market price. Always remember that you have to calculate your disposable income at a market price. You have to calculate your disposable income at a market price. So whenever I am saying this, that is the reason they kind of added the taxes, right? So net national disposable income is net national income plus transfers from rest of the world. So you have three types of transfer payments, right? Transfer payments from government, interest on public debt, and transfer payments from rest of the world. Remember? Yes. So when I write C plus I plus G, this is what the income earned by the economic agents. For this, if you add the transfer payments, then what will you get? You will be getting your disposable income. For this, if you, you have to adjust for taxes as well, net taxes. What do you mean by net taxes? The taxes that you are receiving minus taxes that you are paying. What do you mean by net taxes? The taxes that you are receiving minus taxes that you are paying, right? So if you adjust that with the taxes, then you will be getting your disposable income at a national level. Now, I have only taken transfer payments from rest of the world, right? I have not taken interest on public debt. I have not taken transfer payments from government. Why so? Because, see, government, if it is giving some money to the people or rather to the households, for example, government made some transfer payment of 500. So it is minus 500 for the government. And households are receiving that 500, so it is plus 500. So what will happen? It will set off. It will set off, right? Now interest on public debt. Government is paying, households are receiving. So there it is minus, here it is plus. So it is being set off between your government and households. For that very reason, in the transfer payments, which are of three types, I am only taking into consideration transfer payments from rest of the world. Transfer payments from rest of the world. The remaining are being set off. For that very reason, I am not taking that into consideration. Okay. So what is net national disposable income? Net national income plus net taxes on income and wealth receivable from abroad. I told you, right? Whichever net is receipts minus payments. So you have some obligations. You also have to receive some payments. That is, you have to pay some money. You have to receive some money, right? Next, plus net social contribution and benefits receivable from abroad. This is nothing but your current transfers from rest of the world. It is nothing but current transfers from rest of the world. Clear everybody? Next, what do you mean by gross? Here it is net, right? So after you calculate your net national disposable income, if you add depreciation to that, it will become what? Gross. If you add depreciation to that, it will become gross. See, the other name of depreciation is nothing but consumption of fixed capital. The other name for depreciation is nothing but consumption of fixed capital. Do remember that. So net national disposable income plus consumption of fixed capital, what will you be getting? You will be getting the gross national disposable income. Clear, everybody? Yes, I hope it is clear till here. Let us continue with the next thing. Okay. So we have already completed your private income. So what is your per capita income? Per capita income is nothing but national income divided by population. What is the meaning of per capita income? It is national income divided by total population. So on an average, how much each individual is earning, that you will be getting under your per capita income, right? So next you have your circular flow of income. In your circular flow of income, you have three phases. One is the production phase, second distribution phase, and disposition phase. Okay, final consumption. This is nothing but the final consumption. So in production phase, what do you do? Firms produce goods and services with the help of factor services. What are your factor services? The factors of production, which are land, labor, capital, and entrepreneur. In distribution phase, what will you do? You will disburse the factor payments. For land, you will be giving rent. For labor, you will be giving wages. For capital, you will be giving interest. And for entrepreneur, we will be paying profits, right? And what is disposition phase? After receiving these income, whatever money you are spending for consumption purpose is nothing but the disposition phase. That is, income received by different factors is spent on consumption of goods and services and investment goods, right? So these are the three phases that you have to remember. Next, you have different methods. Okay, in national income accounting, you have different methods. Okay, so first method that you will be learning is value added method. The second method is your income method, and the third method is your expenditure method. So as you have three phases, right, in your circular flow of income, you have three phases. You will be relating the three methods to these three phases. So in your production phase, which method you kind of notice is your value added method. See, even though you have different methods for your national income accounting, you cannot use all the methods in all the, all sectors, okay? Based on the availability of information, you keep changing the methods. So while you're in your production phase, actually value added method is something that requires data, relevant to that, right? So what is the meaning of value addition? Whenever you're, taking up the production process, whenever you're, making the final product, it passes through different stages of production. At each stage, some value addition is happening, right? So you are going to take into consideration the value addition that is made at each stage of production. For example, there is a farmer who is producing wheat, okay? From wheat to end result, that is a baker is selling bread, okay? Till there, what is the value addition that has happened? If you take that into consideration, the value addition at each stage, right? So he has produced wheat. The wheat is bought by a mill owner and he's, making wheat flour. That wheat flour is, bought by some, baker, and he's making bread out of it. And this bread is bought by, a sandwich making company. So it is making sandwiches out of it. So what is happening here? At every stage, some value addition is happening, right? So if you add up all the value addition that is happening, that is your value added method. So what are we doing here in value added method? You don't take into consideration the intermediate consumption. So what is your intermediate consumption? While you are undergoing the production process, you are using some intermediate goods. They cannot be called as final goods. They are being used in the production process, okay? So you are only going to take into consideration the final value, which is the reason you are going to eliminate that intermediate consumption. So you have a formula under your value added method, that is nothing but GVA at market price or GDP at market price. In the earlier session, while we are talking about concepts of national income accounting, I already told you that it is GVA or GDP, okay? When you're talking about supply side, it is GVA. When you're talking about demand side, it is GDP. So what is the formula under your value added method? It is value of output minus intermediate consumption. Okay, intermediate consumption matlab I am talking about the inventories that have been used in the production process. Okay, I am talking about inventories or raw materials that have been used in the production process. What do you mean by value of output? It is sales plus change in stock. What do you mean by value of output? It is sales plus change in stock. What do you mean by change in stock? It is closing stock minus opening stock. What do you mean by change in stock? It is closing stock minus opening stock. Okay, everybody. So what is the formula? You just have to revise. GVA at market price is also GDP at market price. It is nothing but value of output minus intermediate consumption. Intermediate consumption is nothing but the raw material that has been used in the production process. Okay, that I am kind of not taking into consideration. So it is value of output is nothing but sales plus change in stock, right? Sales plus change in stock. In that, what is the meaning of change in stock? It is closing stock minus opening stock. It is closing stock minus opening stock. So the sum of the net values added by all the producing sectors is nothing but your value added method. Is nothing but your value added method, right? So what do you get here? You get GVA at market price. You get GVA at market price. But you know that your national income is measured at NNP at factor cost. Your national income is measured at NNP at factor cost. Now what did you get? You got GDP at a market price. You got GDP at a market price. Students, you also have to remember different methods give different concepts. So under your value added method and expenditure method, you will be getting GDP at market price. Under your income method, you will be getting NDP at factor cost. Please remember this. Under your value added method and expenditure method, you will be getting GDP at market price. Under your income method, you will be getting NDP at factor cost. Okay. So this GDP at market price, you have to transform that into NNP at factor cost. This GDP at market price, you have to transform that into NNP at factor cost. So how will you transform gross to net? It is GDP at market price, right? We have to transform this only, no? So you have to transform gross to net. How will you get net? Gross minus depreciation. Domestic has to be transformed into national. Domestic plus NFIA will give you national. Market price has to be transformed into factor cost. So you have to deduct net indirect taxes. So you have to deduct the net indirect taxes. This is how you will transform your GDP at market price into NNP at factor cost. Okay, next. So what are the inclusions, exclusions and applicability? That also will take into consideration. On account of production of fixed assets. See people, what happens here is sometimes you do things for self-consumption. Even though you are using it for self-consumption, the production has been made, right? The production has been made. So that is the reason self-consumption has also been taken into consideration. Self-consumption also has to be taken into consideration. So how should you take that into consideration? You have to calculate the imputed value. Like what if, like whatever you are using for self-consumption, like what is the value of that service outside if it is actually sold out, something like that. You have to calculate the imputed value and you have to include that. Okay, next, production for self-consumption, that is what here they had talked about fixed assets. Suppose you are a manufacturing firm and you kind of made these machines, but some machines you used for your own purpose, but still you made those machines, right? Even though you used it for your own consumption, you made them, right? So they have to be taken into consideration. You are a farmer, you produced wheat, 1000 kgs of wheat you have produced. In that 200 kgs you have given that in your own family. Even though you have used it for your own self consumption, as you have produced it, that has to be taken into consideration, right? Next, imputed rent of self occupied houses. See, you have your own house, so you don't have to pay rent for that, but you're actually availing the service, no? Like you're having your own house, you're staying in the house, you're taking the benefit, right? So what if the same house, if you had to take it on rent, how much money you had to pay on rent, that also has to be taken into consideration. So it comes under services. Okay, next, production boundary and applicability is what? Agriculture. I told you, right? You have your primary sector, secondary sector, tertiary sector, right? So actually in a primary sector, what you do is that you use your value added method. In your primary sector, you can take the agriculture, right? So in that you use which method? You use value added method. And in your secondary sector, manufacturing sector, you use which method? You use income method. And the final, like tertiary sector, you kind of use which method? You use your expenditure method. You use your expenditure method. See how we have decided that this method has to be used here. It is based on the data availability. I told you, right? If you have to use value added method, you need to have the information with regard to the value addition that is made at each stage of production. So you find that in this. So that is the reason this method is applied here. The next phase is what? It is distribution phase. So here which method are we talking about? We are talking about your income method. See, what we do in your income method is that you have your 4 factors of production, right? So what are the factor payments made to 4 factors of production? That we sum up. And I already told you that in income method, what do you get? You get NDP at factor cost. Students, you already learned this NDP at factor cost in your concepts of national income accounting. So what is the formula of NDP at factor cost? It is the compensation to the employees plus operating surplus. What is the meaning of operating surplus? Rent plus interest plus profit. And we also bought out a new thing called as mixed income of self-employed. Because in the case of self-employed people, I am unable to distinguish what is rent, what is interest, what is profit. I am unable to do that. Okay. For that very reason, I bought out something called as mixed income of self-employed. And if you add all this, you will get NDP at factor cost. When I say NDP, it is net, right? If I have to get gross, what will I do? I will add depreciation to it. I will add depreciation to it. So actually in your income method, what is that you will get? You will get NDP at factor cost. It is nothing but the summation of the factor incomes, factor payments made to different factors of production. Land, labor, capital, entrepreneur. Okay. Compensation to the employees is nothing but the wages and salaries. In wages and salaries, you also have to take cash in, in kind, like whatever, services you are giving in kind, that also have to be taken into consideration. Clear, everybody? For example, for military people, they keep, giving uniforms, right? So that also have to be the services in kind, like kind is what? Service, no? So cash in kind is also taken into consideration. So what is the formula that you see and what is the meaning? First of all, it is the total factor incomes generated in the production of goods and services, right? So what do you see here? Compensation of employees. Next, operating surplus. What is the meaning of operating surplus? Rent plus interest plus profit. All three together are called as operating surplus. Mixed income of the self-employed, and they added depreciation here. So your NDP at factor cost will become your GDP at factor cost. But how do you measure your national income? It is NNP at factor cost. How do you measure your national income? It is NNP at factor cost. So what do you have to do right now? You have to transform your NDP at factor cost into NNP at factor cost. So you have NDP at factor cost, right? So this I have to turn it into NNP at factor cost. So NN both are same. Factor cost, factor cost. The only difference is domestic, national. So if you have to transform the domestic into national, what do you have to do? You have to add NFIA. You have to add NFIA, right? So it is NNP at factor cost is equal to GDP at factor cost minus depreciation. Here they have taken GDP at factor cost, but I told you take NDP at factor cost. Why so much of hard work? Take NDP at factor cost plus NFIA is nothing but NNP at factor cost. I told you, right, your profits have 3 elements, which are corporate taxes, dividends, retained earnings. Retained earnings is nothing but your undistributed profits. Retained earnings is nothing but your undistributed profits. Clear, everybody? Okay. So what are the inclusions that we have to take? Incomes from primary factors of production. So your factors of production are your land, labor, capital, entrepreneur, right? So all the incomes that are earning, we are taking that into consideration. Labor and capital, mixed income of the self-employed. We did include that. Yes, labor is given, compensation, capital, interest, mixed income of the self-employed. We actually included as separate element, right? Next, commission and brokerage. People, here you have to pay very good attention because I'm going to tell you something very, very important. You keep hearing the transaction, that sale of second-hand goods and financial instruments, all that you keep hearing, right? So whenever I'm saying that there is sale of financial instruments, suppose I'm having shares, I'm having a shares of a company, okay, company X shares I'm holding. So if there is a sale of these shares, I am transferring these shares to some other person, okay? So additional productive capacity, is anything being created? No. Until now shares were in my hand. Now from my hand they have been transferred to somewhere else. That's it. So whenever you're talking about these financial instruments, there is only transfer of this wealth. So you cannot take that into consideration as creation of additional productive capacity. And the same goes for second-hand car market, right? So last year a car has been manufactured, and that production of that car has been included in that year GDP. So last year it has been manufactured, and whenever it has been manufactured, that year it has been taken into consideration. Now there was a sale of this car. So second hand car, right? Already this car's accounting has been done whenever it has been produced. Again, you should not take that into consideration. That will result in double counting. That will result in double counting. So always remember, sale of second hand goods should not be taken into consideration. And these, financial instruments, there is only transfer of wealth here. There is no creation of additional productive capacity. But what should we include here is, while this brokerage and commission you keep hearing, right? For me to conduct this sale of sale of goods like second hand goods, whatever is there, I will contact a broker. And he's kind of giving me some service. So for him, what I'm going to pay, I'm going to pay some brokerage fee. That will be taken into consideration because he is giving a service, right? He's giving service, he's rendering the service. So whatever service he is being rendering to me, for that whatever money, whatever brokerage he is receiving, that has to be taken into consideration while your national income accounting is done. Okay. But the sale of goods, second hand goods, should not be taken into consideration. Whatever brokerage service is being paid, that has to be taken into consideration. Right? So commission and brokerage of sale of second hand goods, I'm not taking into consideration the sale of second hand goods. I'm only taking into consideration the commission or brokerage that is paid for taking care of that transaction. Next, imputed service. What is this imputed service? Self consumption. So if anything is done for self consumption, that is also taken into consideration, right? Next, exclusions. So I already told you that transfer payments are not taken into consideration while you're doing national income accounting. Always remember, students, I'm only taking into consideration productive activities. So I'm not taking into consideration this one-way traffic, transfer payments, whatever they're not taken into consideration while you're doing your national income accounting. Next, income from the sale of second-hand goods. Illegal incomes, why will they be taken into consideration? Not at all. So illegal income, capital gains. Why are you not taking capital gains into consideration? You hold a land and then someday you are selling it and then it is giving you some gains. So that is not taken into consideration. Additional productive capacity is not being created, right? So students, one hint that you can take is that whenever you feel that additional productive capacity is not being created, that is not taken into national income accounting. So you don't take capital gains, windfall profits, sudden profits, okay? Some lottery or betting has been done and suddenly you have earned some money. That is also not taken into consideration. Payments out of past saving. So whatever past savings you have done, so payments out of that also is not taken into consideration. Next, interest paid by the government on public debt, because this is considered to be transfer payments. Interest on public debt is nothing but a transfer payments, right? Next, by one firm to other on the consumption loans. I told you, right? Interest payments are considered to be revenue in nature. So they are only, they are only considered as a headache. So they are considered as transfer payments. So they are not taken into consideration in national income accounting because they are not generating any additional productive capacity. Clear, everybody? And when it comes to income method, you apply that in your manufacturing sector. Next, let us talk about your expenditure method. Very, very simple, people. The formula for your expenditure method is C plus I plus G plus X minus M. What is the formula for expenditure method? C plus I plus G plus X minus M. That is consumption expenditure plus investment expenditure plus government expenditure plus exports minus imports. So you kind of take into consideration the expenditure that is made by the economic agents. For that, you add your net exports. What do you mean by net exports? Net exports is nothing but exports minus imports, right? So whenever I am taking your consumption expenditure, I'm talking about your households. Okay. So let us see the formula, whatever they have given here. Let me elaborate that for you. So they have given, I told you, remember, different methods will give you different concepts of national income accounting. So in your income method, you got NDP at factor cost. In your expenditure and your value added method, you will be getting GDP at market price, right? So what is this? Final consumption expenditure. In this final consumption expenditure, you have private final consumption expenditure and public final consumption expenditure. Okay, you have private final consumption expenditure and public final consumption expenditure. This public final consumption expenditure is nothing but expenditure on goods and services by the government. Expenditure on goods and services by the government. Private final consumption expenditure is the expenditure on goods and services by the households. What is it? Expenditure on goods and services by the households. Next, what is this gross domestic capital formation? They are talking about investment. Investment that is increasing the productive capacity. Whenever they are talking about the gross domestic capital formation, they are talking about the investment that is increasing the productive capacity. Okay, and it includes both fixed assets and inventories. It includes both fixed assets and inventories. Whenever I am talking about gross domestic capital formation, I am including fixed assets and inventories as well, because both of them increase the productive capacity of a country, right? And in this, I also include one more term called as, whenever I am investing in valuable assets. So whenever I am procuring valuable assets, that is also called the gross domestic capital formation. For example, I'm, getting some valuable jewelry, I'm getting some valuable paintings, that is also taken into consideration, right? Next. So, but here we got what? We got GDP at market price. Your national income is measured at NNP at factor cost. So it is your responsibility to transform GDP at market price into NNP at factor cost. Remember the three mantras? You have to remember the formula for net. You have to remember how you will get factor cost. You have to remember how you will get national. National is nothing but domestic plus NFIA. Your net is nothing but gross minus depreciation. And how will you get your factor cost? It is market price minus net indirect taxes. Market price minus net indirect taxes, right? So these are your methods. What are these methods? Value added method, income method, expenditure method. Clear everybody? Yes. Next. So they have given a note with regard to your product method, a note on your income method, and yeah. So what they have done was they have explained the elements of your different methods. That's it, nothing more. But what we will do is we'll just go through this also, okay, so that it will give you more clarity. And next is your, a briefing on your expenditure method. These things we have already discussed, but we will do it again for your understanding, okay. This is just an overview of the chapter, so this is not very important, but if you understand these three methods, you are actually done with your national income accounting chapter, okay. So here they have just discussed what is the usefulness and what are the hassles, like some areas where that are left out from the national income accounting just because they cannot be measured. So what are those things? They have just given a brief overview, okay. So let us just start with your explanation part. Let us start with your note 1. So what is your product method? People don't get confused. Product method is also called your value added method. Product method is nothing but your value added method. Okay, everybody. So producing firms are classified into 3 sectors. So what are the 3 sectors? Primary sector, secondary sector and tertiary sector. So again, these sectors are classified into what? Subsectors. Again, your primary sector is classified into subsectors, your secondary sector, and same goes for your tertiary sector. So sectors: primary, secondary, tertiary, each sector into subsectors. Again, subsector is also classified into some commodity groups. Again, subsector is also classified into commodity groups. Okay. So we can take your primary sector as agriculture is there, fishing is there, and their mining is there. So you classified them into subsectors. Under agriculture, you can classify commodity groups, right? You have got millets, you have got pulses. So again, you will classify them into commodity groups. So in total purchases are given, then imports are included in the intermediate consumption. Okay, this is kind of important for you while solving your problems. Please pay close attention. What is the formula under your gross value added method? It is value of output minus intermediate consumption. What is value of output? It is sales plus change in stock, right? It is sales plus change in stock. What do you mean by intermediate consumption? Anything that is used in the production process, the inventories, raw materials are your intermediate consumption. Now, whatever raw materials you are using in the production process, it is not a mandate that they are acquired only in India, right? There is a possibility for you to import that, right? So whatever purchases you are making for the production process, if they give you in the exam that they are only talking about domestic purchases, it is your responsibility that you add imports for that, So So whenever they are talking about intermediate consumption, it includes domestic purchases and imports as well, because whenever you are indulging in the production process, it is not a mandate that whatever raw materials you are procuring, they are only from India. They can also be from abroad, that you will be importing. Okay. Next, whenever I say sales, you not only indulge in domestic sale activity, but also you kind of export goods and services, right? So when I say sales, so you need to include domestic sales and exports as well. So in the question, if they have just given you domestic sales, it is your responsibility to include exports in it as well. Okay. So these are the points we wanted to tell you. Next, under your income method, whenever I am saying compensation to employees, I told you, right, you also kind of take into consideration the service aspect as well. Cash in kind. So wages are there, salaries is there, dearness allowance. What do you mean by dearness allowance? Whenever the inflation is increasing, that is the prices are rising. So what companies do is to match with the rising prices, they increase the salaries by a percentage. Okay, that is your dearness allowance. Next, your commission, bonus, employer's contribution to PF, imputed value of the compensation in kind. What is this? Compensation in kind. I told you, I gave you an example of the military uniforms, right? So they are given uniforms. So this is nothing but compensation in kind. Even though they are not being compensated for their services in cash, they are being offered some services, right? Next, what are your non-labor incomes? One is the rent, royalty, interest on loans for productive services, dividends, undistributed profits of the corporations before taxes, profits of unincorporated enterprises and government enterprises. So these are your non-labor incomes. We have just written rent plus interest plus profit, right? So what they have done is they have elaborated that. So whenever you are calculating your national income, what you do is that you do not deduct taxes, okay? Undistributed profits before corporation before taxes, like before elimination of taxes, you take into consideration. Clear, everybody? Next, mixed income is difficult to separate labor income from capital income. I already told you, right? In some cases, if you are a self-employed person, I cannot tell you whatever money you are taking after, the operations of the business, you are taking some money home. So what is the wage portion? What is the interest portion? I am unable to, separate it. So that is the reason we introduce a new category called as mixed income of self-employed. Clear, everybody? So what I want you to focus on, which area is that? I want to focus here, okay, undistributed profits of corporations before taxes. So always remember that I'm talking about, whenever I'm talking about non-labor income and I'm talking about profits, right? In that profits, I'm talking about the profits before paying the taxes, okay? So that you have to take into consideration. That is the reason while I was discussing your national disposable income, I told you that this whatever business firms, economic agents you have, governments, households and business firms. So national disposable income is I'm taking into consideration all these three people, right? So when I'm taking into consideration all these three people, so I am not actually, deducting the taxes for, corporate profits. I am actually taking corporate profits before the deduction of your corporate taxes. Okay. Next, so who are the examples for self-employed people? Lawyers, engineers, traders, and subsistence production and small commodity production is dominant in agriculture, trade, transport of underdeveloped countries, including India. See, India is like a developing country, right? So, there are other underdeveloped countries like Africa and such, but India is kind of a developing nation, but we are yet to become developed nation. That will be, that will be happening very soon. We see signs of that happening because there are many aspects that are being corrected in the economy. We are actually moving in a positive scenario, towards a positive scenario. Okay. Next, so let us see the aspects that we have to focus on your expenditure method. So what is the formula for your expenditure method? It is final consumption expenditure plus gross domestic capital formation plus net exports. They have just given you final consumption expenditure, right? In that final consumption expenditure, you have your private final consumption expenditure and government final consumption expenditure. So what do you mean by final consumption expenditure by private? I'm talking about households here. So final goods and services produced in the accounting period, primary products are produced for own consumption by the household. So always remember that self-consumption is also taken into consideration. Madam, how will you take self-consumption into consideration? Please calculate the imputed value. Please calculate the imputed value. Next, payment for domestic services, the net expenditure on foreign financial assets. So what do you mean by net expenditure here? It is brokerage. They're talking about brokerage. They're talking about what? Brokerage and commission. Okay. Next, government final consumption expenditure is, you know that government keeps incurring expenditure on your education, health as such. So that is taken into consideration. Transfer payments are excluded. While calculating your national income, students, please do remember that you only have to take into consideration the productive activities. You should not take into consideration the transfer payments. Next, gross domestic capital formation. What do you mean by that? It is investment. Whatever is adding to the productive capacity of the nation, that is taken into consideration. It might be inventory investment or fixed asset investment, right? Next, gross domestic capital formation includes machinery and equipment, own production, that is, this is self-consumption. I told you, right? Self-consumption also has to be taken into consideration. Next, expenditure on construction, land and residential buildings constructed by households. So whenever you are doing this residential investment, that is also taken into consideration. Next, expenditure on acquisition of valuables such as jewelry and work of art. So what are the things that you include in your gross domestic capital formation? Anything that increases the productive capacity. So these residential investments, what are the investment activities by households, whatever residential investments, and when it comes to business firms, the plant and equipment, whatever they are buying. Also the inventory investment also has to be taken into consideration, and any valuables, that is also taken into consideration, right? So next, in India, when national income of a country is measured separately using this method, we get three-dimensional view of the economy. We are unable to estimate national income wholly by one method. So what is the reason that you are unable to use one method here? See, the only reason is that data availability. See, based on the availability of data, we are kind of using the methods. So for all the sectors, it is impossible to use one common method. So this was your national income accounting. But what my suggestion would be is, if you do some problems, you will be having a clear picture of this chapter. So what we will do right now is, we'll proceed with your problems. We'll start solving few problems which will give you in-depth clarity with regard to the chapter, and you will actually feel comfortable. Okay, I have listened to the lecture. Okay, I gained something. I am able to do some problems. Mostly students encounter problem with personal income calculation and private income calculation. So we are going to address that issue in this session. So what we will do right now is, we will solve some problems pertaining to your different methods. That is your expenditure method, income method, and also your value added method. First, we'll start with your value added method. So if we have to revise the formula of your value added method, it is value of output minus intermediate consumption. So what is your value added method? You are taking into consideration the value addition made at different stages of production, right? So what you do here, as you can see in the question, you have the value of output in the primary sector, intermediate consumption of the primary sector. So how will you get the value addition that happened in the primary sector? It is value of output in primary sector minus intermediate consumption of primary sector. In the same way, they have given for secondary sector and tertiary sector. So in your value added method, you take the value addition made at different sectors, you sum them to get the value addition made in the entire economy, right? So what will you do here? Value of output in the primary sector minus intermediate consumption of the primary sector, value of output in the secondary sector minus intermediate consumption of the secondary sector, plus value of output of the tertiary sector minus intermediate consumption of the tertiary sector. Clear, everybody? So always remember that in your national income accounting, the reason why I am not taking intermediate consumption is, I am only taking into consideration the final value of goods and services. See, directly you can take the final value, that is not an issue. But if you kind of add the value addition made at each stage of production, that will also give me the final value of the good. If you add the value addition made at each stage, that will give me the final value. So that is the reason I am eliminating the intermediate consumption. And do you remember, intermediate consumption includes domestic purchases plus imports. Value of output is nothing but sales plus changing stock. And sales includes domestic sales plus exports. So that is all you have to remember. Your national income is measured in terms of NNP at factor cost. So, but in your expenditure method and your value added method, what will you get? You get GDP at market price. So you have to transform that into NNP at factor cost. How will you do that? The three mantras, do you remember? The gross you have to transform into net. So how will you transform gross into net? You will deduct depreciation. Domestic you have to transform into national. You will add NFIA. Market price you have to transform into factor cost. You have to deduct the net indirect taxes. By that you will get the answer under your what? Value added method. So the formula that you have to remember for value added method is value of output minus intermediate consumption. Okay. So this was one. I hope you all understood. What we will do right now is that we will solve your income method. So what is the formula for your income method? It is compensation to the employees plus operating surplus. What is operating surplus? Rent plus interest plus profit, and it is mixed income of the self-employed. If you do that, you will get NDP at factor cost. Okay, all the things that I am telling you right now, if you add them up, you will get NDP at factor cost. But what do we want? We want NNP at factor cost. So for transforming domestic into national, you will add net factor income from abroad. Okay, so compensation to the employees plus mixed income of the self-employed, and next plus operating surplus is rent plus interest plus profit. If you add all these three, you will get operating surplus. So if you add all these three, compensation to the employees plus operating surplus plus mixed income, you will get NDP at factor cost. Okay, for this, if you add NFIA, you will get NNP at factor cost. People, these are irrelevant items. Okay, they are given just to confuse you. Okay, always remember that which method gives you which concept. Okay, income method will give you NDP at factor cost. So you only have to worry about NFIA to get your NNP at factor cost. Okay, everybody? Yes. Next, another method that you have is your expenditure method. What is the formula for your expenditure method? C plus I plus G plus X minus M. Okay. So, private final consumption expenditure is of households. You have to take this into consideration. Net import, it seems. So, if net export comes, it is exports minus imports. Exports is bigger. So, you have to add. If it is net imports, you have to deduct this. Okay. Next, public final expenditure is of government. So, you have to take this into consideration. Gross domestic capital formation, but they are only talking about fixed capital formation. So if there is inventories, that also you have to add. So this you have to take into consideration. People, remember that gross domestic capital formation includes any addition that is made to the productive capacity. It can be in the form of fixed assets, it can be in the form of inventories. As they specifically mentioned that it is regarding fixed assets, inventories you have to take into consideration. So where do you have inventories? Change in stock, that is your inventory. Okay, this also have to be added. Next, what else? Net acquisition of valuables have to be taken under what? Gross domestic capital formation. So under gross domestic capital formation, you have to take the addition to fixed assets, you have to take the addition of inventories, you have to take the valuables, you also have to take the valuables. Okay, so these are the things you have to consider. So what is the solution? It is government's final consumption expenditure, which is nothing but public, plus private final consumption expenditure. People, public final consumption expenditure plus private final consumption expenditure is nothing but final consumption expenditure. Public final consumption expenditure plus private final consumption expenditure is nothing but what? It is your final consumption expenditure. Yes, gross domestic capital formation is nothing but fixed capital formation plus change in stock plus net acquisition of valuables. So this will give you what? Plus net exports. Here there are net imports. Now you have to minus that. You have to minus that. And next, what will you get because of that? You will be getting your GDP at market price. But you want NNP at factor cost. So if you want net, you have to deduct depreciation. If you want national, you have to add an FIA. If you want factor cost, you have to deduct net indirect taxes. So we have seen three examples for your three methods. Now what we are going to do is we are going to solve some problems with regard to your personal income and private income so that you will not be having any queries. Okay. So let me start with your, okay. Yeah. Let us do this problem, or let us, yeah. Okay. So let us do this problem. Okay. So what is the information that they have given? They are asking us to calculate the national income. National income is nothing but NNP at factor cost. What is national income? NNP at factor cost. How do you get that? What is that they have given here? NNP at market price. People, NNP at a market price. If you minus net indirect taxes, will you get NNP at factor cost? Obviously, you will get NNP at factor cost, right? So what is NNP at market price? It is 1891. So do you have any net indirect taxes in the table? They have given indirect taxes and subsidies. See, net indirect taxes is nothing but indirect taxes minus subsidies. So what is your net indirect taxes? It is 175 minus 30. It is 145. So net indirect taxes is 145. So what is the NNP at market price? 1891 minus 145 will give you 1746, which is your national income. So let us see the options if they have that. So 1746 is your national income. So we have got your national income to be 1746. This was simple, right? Now we got your national income. In national income, do we take transfer payments into consideration? We do not take transfer payments into consideration. Transfer payments, how many types are there? Transfer payments from government, interest on public debt, transfer payments from rest of the world, right? So while calculating your private income and personal income, transfer payments have to be added. Transfer payments have to be added, right? So let us see here. The first we'll calculate the private income. What was the next question? Did they ask us? Yeah. First we'll calculate the personal income. They are not asked private income. We'll do that later. Let us calculate the personal income. So in your national income, I have got 3 agents: households, business firms, government. So while calculating personal income, I am only bothered about whom? I am only bothered about households. So I'll eliminate the remaining. So in national income, I had all the 3. So I have to eliminate business firms and government. What is this? Income from property and entrepreneurship accruing to government. Should I minus this? Obviously, I have to minus this, because for personal income, do I require government? I don't require government. So people, whenever you are reading the table, whichever is required, put a plus. Whichever is not required, put a minus. So this is minus. Indirect taxes, subsidies are already adjusted. They are not required for us right now. Next, savings of non-departmental enterprises is of government. So as you're calculating personal income, government is not taking into consideration. So this is minus. Interest on public debt is a transfer payment. While calculating personal income, we have to take transfer payments into consideration. So this is plus. Current transfers from government, transfer payments plus. Next, current transfers from rest of the world, transfer payments plus. Savings of private corporate sector. This is nothing but undistributed profits. People are retained earnings or undistributed profits being given to the households. No, they are not given to the households. So this has to be minus. Corporate profits, are they going to households? They are not going to households. So minus. They are not going to households. So it is a minus. Okay, everybody? Yes? Fine. So what we will do is we will solve it. So initially what we got? 1746, right? So 1746 minus 45 minus 10 plus 15 plus 35. What else? Plus 20 minus 25. So it is minus 25 again. It is around, so somewhere it went wrong. We'll do this again. So what was it? We'll do this again. So the calculation part. So 1746. But if we are right, there is no option for that. We will just verify it. Okay. 1746 minus 45 minus 10 plus 15 plus 35, yeah, plus 20 minus 50. So the answer is 1711. The answer is 1711. So it is option C. Okay. So did you understand how we did the personal income? We kind of eliminated your business firms and government, and we added your transfer payment. That is how you do it. Next, let us calculate your private income. Okay. Let us see if they asked your private income at least in this question. No, they haven't. So let us do one private income question. Yeah, very good. Here they ask private income. The question is also looking big. Okay. So what is that they have given in the question for you? Factor income from NDP accruing to private sector. They made our job easy actually. So private sector includes only households and business firms. So they have not included government here. People always remember that whenever in the question they are giving you NDP that is accruing to private sector, that is not taking into consideration the government sector. Okay. Now for calculating private income, we already have the NDP that is accruing to private sector. We already have the NDP that is accruing to private sector. Now what do we have to do here? This is NDP. So you have to add NFIA to make it NNP. This is what NDP, but we want NNP, right? And in national income, do you include transfer payments? You don't. So you have to add all the types of transfer payments. So what is the NDP that is accruing to private sector? It is 300. Next, income from property and entrepreneurship. This is irrelevant because in private sector, there is no government. So you have no role to exclude it. Okay, your job is done actually. The question is very, very simple. Savings of non-departmental irrelevant for right now. Factor income from abroad. So what is this factor income from abroad? Matlab it has to be added. Okay. Consumption of fixed capital irrelevant because we are already talking about net value, right? So depreciation is taken. Depreciation is also called as consumption of fixed capital. Next, current transfers from rest of the world. It is a transfer payment. So please add it plus 15. Next, corporation taxes. It must be there because this is already included. Yeah. Whenever they say NDP accruing to private sector, they have taken all. This is already inclusive of it. Factor income to abroad. So please deduct factor income to abroad minus 30. Next, current transfers. Transfer payments have to be taken into consideration plus 40. Next, direct taxes. See, taxes are relevant when you are calculating disposable income. Here we are only calculating private income. National debt interest. It is a transfer payments. So plus 5. Savings of private corporate. Not relevant for right now. So how much did you get? You got 350. See, very simple trick, people. So whenever you are calculating private income, make sure that you are having households business sector. For that, what will you add? You will add transfer payments to that and your job is done. Your job is done. Okay. So these were the examples that I was wanting to talk to you. So I hope that you got some clarity with regard to the lesson. What my request would be is that for national income accounting, things will get easy for you if you are aware of the formulas. Okay. So if you are not aware of the formulas, it is very complicated for you. And there are not many formulas. Many students have this misconception. Okay. See, if you know one, you can derive the other. You just have to remember the 3 mantras. You just have to remember the formulas in your 3 different methods. That's it. Half job done. And for personal income and private income, you just have to know what has to be included, what should not be taken into consideration. And always remember that in your disposable personal and private income, you take transfer payments into consideration. Transfer payments are 3 types. You know that, right? So this is what you have to remember in this chapter. It is not at all tough. It is very, very easy. You just have to understand the approach for this chapter. Clear, everybody? I hope that you got some information. You enjoyed the lecture. I'll see you in the next one. Thank you so much. Hello everybody, welcome back to another session of Economics of Finance. In the previous session, we had a discussion with regard to national income accounting. So in this session, we'll proceed with Keynesian determination of national income. As you all know, one of the most interesting chapters that you have in Economics for Finance. So before, proceeding with the chapter, I would like to, talk a few words about Keynes, how he achieved his prominence. As we all know that till Great Depression, it was your classicals who were very prominent. Classical's ideology of full employment, supply creates its own demand, the wage and price flexibility. But what Keynes said was this is not actually working in real life scenario. But when Keynes came up with his ideology, people were not very accepting with regard to his ideology and kind of refuted him. So when after Great Depression happened, people realized that okay, Keynes was actually right. So then they started believing in Keynes. So the Great Depression has made Keynes achieve so much of popularity. So in this session, what we are going to do is we are going to discuss the chapter as I have told you. We are going to complete the entire chapter in a span of just 1.5 hours or something like that. So it will be very easy for your revision purposes as well. So in this chapter, you have got the Keynesian 2-sector model, 3-sector model, 4-sector model. But before discussing the 2-sector, 3-sector model and the 4-sector model, it is very important that we understand some key terminologies to understand this chapter. Okay, so let us start. So what do they have in the beginning here? John Maynard Keynes have become popular with his book. What is the name of the book? It is the General Theory of Employment, Interest and Money. What is the name of the book? General Theory of Employment, Interest and Money, right? Next, what are the different concepts that Keynes has introduced? Some of them are income consumption relationship. As we all know, there is a direct relationship between income and your consumption. Keynes has also talked about the multiplier, which we'll be discussing in this chapter. He's talked about liquidity preference again, which we'll be discussing in this chapter. Okay, so what do you mean by liquidity preference? To be very honest, this liquidity preference theory that was discussed by Keynes, you will actually be talking about more detail in your theories of money demand. So you have the liquidity preference theory, right? So what Keynes has to say about this liquidity preference? What he said was, when the interest rates fall below a range, people will expect the interest rates to rise further and a liquidity trap is formed. That is, people will be holding all the money and they'll not be spending anything. So liquidity trap is nothing but it is a situation where the interest rates fall so low that people hold the money to themselves, okay, which we'll be discussing when you talk about your Keynesian theory of liquidity preference in theories of money demand, which we'll be doing it in the later sessions, okay. Next, the importance of expectations in affecting consumption and investment. And Keynes also stated that your investment depends on the marginal efficiency of the capital, like how profitable it is for me to invest. And it kind of depends on the expectations of the investors. They may be optimistic or they may be pessimistic. So he said that rather than interest rate, it depends on the marginal efficiency of capital. But why Keynes has not given so much of importance to interest rate is that you do remember that Keynes came during your Great Depression. And during the Great Depression, even though the interest rates fell so low, the pessimism of the investors was not going and they are not reviving with optimism. Okay. For that very reason, investments were not so responsive to the interest rates. For that very reason, Keynes stated that your investments is a function of marginal efficiency of capital. Okay. Next, shifts in the demand and output due to shifts in the expectations. In our session, our sole focus will be on the 2-sector, 3-sector and the 4-sector model. Right, what are the key terminologies? What do you mean by equilibrium? See, equilibrium is a condition of steady state or a happy state. After reaching equilibrium, you don't want to move, right? So it is the point where your aggregate demand is equal to aggregate supply. Whenever I am saying aggregate demand is equal to aggregate supply, there are other ways you can, there are other terminologies that you can use to, say this. So what are the other terminologies? One is the quantity of output produced is equal to quantity demanded. Aggregate supply is equal to aggregate demand. Next, production plans of the firms is equal to expenditure plans of the households. What is the production plan of the firms? It is nothing but the aggregate supply. The expenditure plans of the households is related to aggregate demand. Next, aggregate income is nothing but aggregate supply. See, your aggregate supply is also known as the aggregate income is equal to the aggregate expenditure or your aggregate demand. So your aggregate demand is also referred to as your aggregate expenditure as well. Next, expected value by the firms is equal to realized value by the households. Even like this also you can express your aggregate demand and aggregate supply. The last one is leakages is equal to injections. Let us talk about what are leakages, what are injections. See, in your economy, what are considered to be leakages are your savings are considered to be leakages, taxes are considered to be leakages, imports are considered to be leakages. Why are they considered to be leakages? Because they reduce the income. They reduce the income. In which way? See, when savings are happening, you're not spending, right? When you're not spending, you're not creating demand. So what will happen to the aggregate demand? It will fall. Excuse me. When taxes are increasing, what will happen to the disposable income? It will decrease. See, what is the formula for a disposable income? It is personal income minus personal taxes. So when taxes are on an increase, what will happen to the disposable income? It will decrease. When disposable income is decreasing, what will happen to the spending again? That will decrease. When spending is decreasing, what will happen to the aggregate demand? Again, it will see a downfall, right? Next, imports. Imports means what? You are demanding foreign goods and services and you are generating income for that country from where you are importing. You are not generating any income for my country. See, imports are considered to be a leakage because you are not generating the economic activity of our country, but you are generating the economic activity of some other country. right? So savings, taxes and imports are considered to be leakages, that which is going out of the economy and which is reducing the aggregate demand. Now, which will increase your aggregate demand or which will increase your economic activity is considered to be injections. So investments are considered to be injections. So whatever savings are happening, if they are coming back into the economy in the form of investments, then you are said to be in equilibrium. Whatever taxes are being collected, as it is a leakage, if the taxes collected are coming back into the economy in the form of government expenditure, then it is considered to be injection. See, whenever you are importing something, if you are, trying to export goods and services, which is increasing our economic activity, then also you are said to be in equilibrium. So, investments, government expenditure, exports are considered to be injections. Leakages reduce the economic activity, injections increase the economic activity. So, if the reduction is equal to the increase, then you are said to be in equilibrium. If the reduction is equivalent to the increase, you are said to be in equilibrium. Clear? So these are the topics I wanted to talk on. Next, in the Keynesian sector models, equilibrium is explained in two topics, which is aggregate supply and aggregate demand, and the other is leakages are equal to your injections. Now let us also learn something called as ex post terms and ex ante terms. Whenever you hear ex post, it indicates actual. What is the meaning of ex post? It is actual. What is the meaning of ex ante? It is anticipated. What is the meaning of ex ante? It is anticipated. What is the meaning of ex post? It is actual, right? So ex post terms are actual or realized accounting values, which is nothing but actual GDP. For example, GDP is the final value of goods and services produced. In actual, how many goods are produced? That is your ex post. Okay. Whatever you're planning to, whatever you're anticipating, that is your ex ante terms, right? Ex ante. Anticipated or intended or planned accounting values. So what Keynes has considered is ex ante terms. So he has considered the planned terminologies, right? So planned investment, planned savings, potential GDP, all that. Okay. So example, people's plan to consume or planned investment. Clear? So what will you say if people say it is ex post? It is actual value. Ex ante is the anticipated value. Okay, something that you're planning to do. Next, equilibrium income versus potential income. See, potential income is something that you can produce if you utilize all the resources efficiently. See, this is your full employment level. Your potential income is your full employment level. That is, there is no underutilization or there is no overutilization. There is no excess capacity. That is your potential income. But Keynes has always said that it is not a mandate that your equilibrium income has always be equal to your potential income. For example, if I say YF is your potential level of income, YF is your potential level of income because this is the income that you are producing at the full employment level. Full employment meaning is there is no underutilization, there is no overutilization. But Keynes was saying that there is a possibility for involuntary unemployment as well. It is not that the economy will always be operating at the full employment level, which the classicals has said that the economy will be always be operating at full employment level. This is where Keynes refuted classical, saying that no, you are wrong, because in an economy there is a possibility for involuntary unemployment as well. Okay, so there can also be underutilization. Your economy need not operate at the full employment always. Okay, so whatever equilibrium income that you're seeing, what is the equilibrium where AD is equal to AS? That need not take place at the full employment level. It can also take place at a level that is less than the full employment level. So when it is less than the full employment level, it indicates that there is deficit demand. There is deficit demand. That is what happened during Great Depression, right? So the reason behind the occurrence of Great Depression is there is no proper demand, or there is no, the demand that is required. So there is deficiency in the demand, which has led to the Great Depression. That is why Keynes has asked that government must intervene to correct this failure. But classicals always promoted lazy sphere economy or capitalist economy or free market economy. They said that government need not interfere. If it takes care of these military operations, all that, it is fine, but government need not intervene in the market. But Keynes stated that your market cannot adjust itself always. So there is a requirement that government intervenes into the market sometimes to correct the failure. Okay, next. So they have given a table with regard to your leakages and injections. Let us see what they have written here. A leakage is an outflow or the withdrawal of income from the circular flow model. So whenever you see a leakage happening, it kind of decreases the economic activity. Whenever you see an injection happening, it increases the economic activity. Next, Savings, imports and taxes are your leakages. Next, investment, government expenditure and exports are your what? Injections. Investment, government expenditure and exports are your injections. Leakages arise due to what? What is the reason behind the leakages? See, do you remember in national income accounting we discussed that corporate profits include dividends, corporate taxes and your what? Undistributed profits. Undistributed profits or retained earnings. Your undistributed profits or retained earnings are a form of savings. So savings are considered to be a leakage because they are not entering into the economy or entering into the circular flow. If they enter into the circular flow, they will generate some economic activity. But if they are lying idle, there is of no use, right? So that is the reason whatever taxes you are collecting, if they are spent in the form of government expenditure, it is considered to be an injection. Clear? I hope I have made myself clear with regard to leakages and injections. Next, circular flow of income. This note point is really important. If leakages are greater than injections, what will happen to the national income? It will definitely increase, because if leakages kind of reduce the economic activity, right? So the things that are reducing the economic activity, if they are greater than the things that increase the economic activity, the end result will be a fall in the economic activity. If your injections are greater than leakages, that is, the activities that are increasing your economic activity are greater than the activities that are reducing the economic activity, then you will see a rise in your national income. Clear, everybody? Next, let us proceed to something called as circular flow of money. Okay, so what is the circular flow of money? So in this model, what we are going to do is we are kind of discussing the basic model where you will be having your firms and households. So you have three economic agents, right? Business firms, households and government. In this simple circular flow model, I am only taking into consideration firms and households. I am not taking government into consideration. So if I am not taking government into consideration, there is no taxes or there is no government expenditure. Clear, everybody? So your personal income is equal to your disposable income. See, if there is no government, there will be no taxes, right? So what will be your personal income? That will be equivalent to your disposable income. They are the things that you have to remember. And while discussing this simple circular flow model, you also have to remember some assumptions. Okay, so primarily how many players do you have? You have primarily two players in this model, which are households and business firms. Okay, and you are taking an assumption that your households are not saving anything, but they are spending the entire money. Your households are not saving anything, they are spending the entire money. You also take an assumption that there are no proper financial institutions. See, that is the reason why whatever the households are receiving, they are spending the entire money, right? So, and the companies are also not having any sort of retained earnings. See, retained earnings or undistributed profits is the savings of the companies, right? So, they are also not saving anything, okay? So only two primary players, which are your households and corporations, right? There are no corporate savings or retained earnings. Okay, there are no corporate savings or retained earnings. No government. As there is no government, there will be no taxes, and your personal income is equal to your disposable income. Economy is a closed economy. What do you mean by a closed economy? There is no foreign sector. That is, you're not having transactions outside the country. Okay, no foreign dealings are present. So you're a closed economy. What is the meaning of open economy? The presence of a foreign sector is, then it is called as an open economy. Okay, so let us see a small diagram here. As you can see, there are households and there are firms. Okay, so what households do in this model is that they supply the factors of production which are used by the business firms to produce the goods and services. What households are doing here? They are supplying the factors of production which are being used by the firms in the production of goods and services. Okay. Now what firms are in return doing for that? They are paying factor payments. Like, what are factor payments? For land you pay rent, for labor you pay wages, for capital you pay interest, and for entrepreneur you pay profit, right? So the factor payments are the money incomes that are earned by the households. So whatever factor payments that are receiving in the form of rent, wages and interest, they are in turn spending that on goods and services that are made by the firms. Okay, so in this way money is flowing between firms and households. First, the household has sent what? Factors of production to produce goods and services. In return, what did the firm send? They sent the factor payments. On behalf of, like, after receiving the factor payments, what did the households do? They use that money to spend on goods and services, right? So in this way, again, the firms received the money. And here you have to remember this assumption that households are not saving anything. Households are not saving anything. Okay. So households, they own all the factors of production and sell their factor services to earn factor incomes and are entirely spent. So there is no portion of savings here. So firms hire factors of production from households, produce and sell goods and services to households and do not save. So even the firms are not having any sort of retained earnings, undistributed profits or corporate savings. Okay. Circular broken lines. So as you can see here, you have a full-fledged line and you have broken lines, right? So these broken lines, whatever they are, you can see, they represent the factor and product flows, which are the real flows. Like I am sending factors of production to the firms, right? So it is considered as real flow. In return, I am receiving factor payments, right, in terms of money, that is called as money flow. Whatever I am receiving in terms of money is called as money flow. Whatever factors of production I am sending, whatever goods and services firms are sending, that are considered to be real flows, right? No injections or leakages from the system. I told you, right, if there are no savings, there will be no investments. If savings are there, leakage will be there, and that has to be, corrected by injections in the form of investments. Next, equilibrium under the two sector model, very important. Please remember this condition. See, factor payments is equal to household's income. Whatever factor payments that is being made by the firms is nothing but my income. Okay. And my income is whose income? The firm's income, because I am spending the entire income in the form of expenditure, and that expenditure is nothing but the receipts of the firm, and the receipts of the firm is equivalent to whatever value of the output that they have produced. See, using my factor services, they have produced something, right? That output has a value. So that is equivalent to the total receipts of the firm. That is equivalent to the household expenditure. That is equivalent to the household income, and which is equivalent to the factor payment. So everything is equal here. Clear, everybody? Yes. Next thing is basic concepts and functions of the Keynesian two-sector model. Now we are going to start with the discussion with regard to two-sector model. See, in Keynesian two-sector model, you only have your households and business firms. Okay. In the Keynesian two-sector model, you only have your households and business firms. In the three-sector model, we add your government. In the four-sector model, we also add your foreign sector. In the four-sector model, we add your foreign sector. So what we are going to do right now is, we are going to gain some knowledge with regard to these terminologies, like what is MPS, what is MPC, what are their values ranging from, what is APS, what is APC. So all that we are going to understand here. Clear, everybody? So let us start our discussion with regard to the two-sector model. Before that, let me write something down for you, okay? In the two-sector model, you have C plus I. In the three-sector model, you have C plus I plus G. In the four-sector model, you have C plus I plus G plus X minus M. These are the things that you have to remember, okay? So it is consumption expenditure plus investment expenditure is equal to two-sector model. Consumption expenditure plus investment expenditure plus government expenditure is equal to three-sector model. Consumption expenditure plus investment expenditure plus government expenditure plus exports minus imports. This is nothing but net exports is equal to the four-sector model. Clear? This is that simple. So this lesson is going to be very, very simple for you if you just listen to some basic terminologies, and we'll complete it for you. Fine. So what do we start with? Let us start with aggregate demand. Your aggregate demand is also called your aggregate expenditure. I told you, right, in your Keynesian world, we are talking about ex ante terms. So ex ante is planned. Ex ante is nothing but planned. Okay. So planned aggregate demand, planned expenditure. Clear, everybody? Yes. In a two-sector model, AD for final goods and services is the sum of ex ante aggregate demand for consumer goods and ex ante aggregate demand for investment goods. So aggregate demand is equal to consumption expenditure plus investment expenditure. So of the two components, consumption expenditure accounts for the highest portion of your GDP. Around 70% it is accounted by consumption expenditure. Right, everybody? Next, investment expenditure is assumed to be constant in the short run. This is also very, very important. According to Keynes, in the short run, your I is constant. And whenever something is constant in economics, you denote with I bar. You draw a bar on top of that to denote that it is constant. Okay. So in the short run, your investment expenditure is constant. So your, AD is equal to C plus I bar. AD is equal to C plus I bar. Okay. So it is consumption expenditure plus investment expenditure, which is constant in the short run. Why are we talking about short run? Because you are in Keynes world. In Keynesian world, you are only talking about short run, because Keynes only focused on short run, saying that in the long run we are all dead. But classical spoke about long run. Clear everybody? Yes. AD represents the realized value by the households or households plan to consume. So whatever households are planning to consume is nothing but your aggregate demand. And next, AD is the linear and positively sloped, because whenever your national income is increasing, your aggregate demand will also increase. That is, whenever Y is increasing, what will happen to aggregate demand? That will also increase. But there is something that you have to notice here, which I will help you here understand. Okay. So for your equilibrium, you need both aggregate supply, aggregate demand. Students, always remember that your aggregate supply line is a 45-degree line. Your aggregate supply line is a 45-degree line, and it is also called your reference line. It is also called your reference line. And your aggregate demand line is flatter when compared to your aggregate supply line. Your aggregate demand line is flatter when compared to your aggregate supply line. Okay. Your aggregate supply line is nothing but your income line. It is your income line. Your aggregate supply is also called as your aggregate income, right? And AD is nothing but C plus I bar, right everybody? Yes. So what do you observe here? Your aggregate supply line is a 45-degree line, but your aggregate demand line is a bit flatter, right? What is the reason that it is flatter? Because whenever the income is increasing, the consumption will also increase, but less than proportionately to the rise in your income. I'll repeat this again. So the reason why your aggregate demand is flatter is because your incomes are increasing, consumption will also increase, but the proportionate increase in the consumption is less than the proportionate increase in your income. For that very reason, your aggregate demand line is flatter. Clear everybody? Yes. So this is your aggregate demand or aggregate expenditure, right? So the difference between your Y and your aggregate expenditure is nothing but the savings in the economy. So what do you see here? At this particular point, like till the highlighted region, you see that your aggregate demand is greater than your aggregate supply. That is, your aggregate expenditure is greater than your aggregate income. Whenever your expenditure is greater than your income, we say that you are dissaving. We say that you are dissaving. And at this particular point, your aggregate demand is equal to aggregate supply. Your aggregate demand is equal to aggregate supply. Here the savings are 0. Here you are not dissaving or neither you are saving. Okay. So beyond this, if you go, your aggregate supply is greater than your aggregate demand. So your income is greater than your expenditure. So what are you doing in this region? You are saving. So in the beginning of the career, you are dissaving. In the middle, there are no savings. After a particular point of time, you are saving so as to accumulate wealth. Clear everybody? So in the beginning, it is dissaving. So when aggregate demand is greater than aggregate supply, you are dissaving. When aggregate demand is equal to aggregate supply, you are not saving anything. When aggregate supply is greater than aggregate demand, what is happening here? You are saving. Clear everybody? We'll proceed to the next one. So aggregate demand line is flatter than the 45-degree line. What is the reason? Even though the income is increasing, the proportionate increase in your consumption is less than the proportionate increase in your income. For that very reason, your aggregate demand line is flatter. Clear everybody? Yes. Next, aggregate supply is also referred to as your aggregate income, aggregate supply, or a planned aggregate supply. Okay. So what is your income equal to? You can either use for consumption or you can either use it for saving. What is your aggregate income to? You can either use it for consumption or you can either use it for your savings, right? Next, total supply of goods and services firms in an economy plan to sell during a specific period of time. So I told you, right, in the Keynesian world, you are using the terms ex ante terms. You're using the terms ex ante, that is planning to sell, right? Next, it is the expected value by the firms or the producer's plan to produce goods or services. Aggregate supply is equal to the national income of the economy, which is either consumed or saved. So what is your aggregate supply equal to? It is equal to your national income. So your national income is denoted by Y. It can either be used for consumption or it can either be used for savings purpose. See, after eliminating your consumption, the remaining portion is left for savings, right? Next, let us have a discussion with regard to the consumption saving function or the income consumption function or the income savings function. Okay. So what do you see here? Consumption function, level of C at each level of income. So your consumption function is nothing but, let us, do it in the notepad. I'd already told you that your aggregate demand in a two-sector model is nothing but C plus I. And in the short run, your investment is autonomous, it is independent of the income, and it is also constant. It is also constant. So let me denote it with I bar. Let me denote it with I bar. Okay. And your consumption equation is nothing but A plus BY. Your consumption equation is A plus BY. Okay. So in this consumption equation, you have two components. One is the autonomous component, the other is the induced component. So A is your autonomous component or independent component. What do you mean by autonomous or independent component? Autonomous or independent component is that irrespective of the income, your consumption will be equal to A. Irrespective of the level of income, your consumption will be equal to A. That is, if you put Y equal to 0, your consumption will be equal to A. If you put Y equal to 0, your consumption will be equal to A. Okay. So that very reason we call that as autonomous consumption or independent consumption. Now what is BY? BY is your induced consumption. That is that which is dependent on the level of income. What is BY? Induced consumption. That which is dependent on the level of your income. Clear everybody? So what do you call BY? Induced consumption. Okay. So in your C is equal to A plus BY, Y is the independent variable. C is the dependent variable. C is your consumption. Consumption is dependent on income. So you can write consumption as a function of your income, right? So C is your dependent variable and B is your slope, which is nothing but the marginal propensity to consume. What is B? It is marginal propensity to consume or your slope of the consumption function. What do you mean by marginal propensity to consume? It is nothing but delta C by delta Y. It is nothing but delta C by delta Y. So change in consumption due to change in the income. How much is your consumption changing if there is a 1 unit increase in the level of income? That is the slope, which is denoted by MPC delta C by delta Y. This is your consumption equation, right? So what we will do right now is we will see what they have written. So consumption function, C at each level of income, right? So this is your consumption function. The blue line that I am highlighting, this is your consumption function and this is your income line. The 45-degree line that you're seeing is your income line. It is also called your reference line. As I have already told you, your income can be spent on two purposes. You can either use it for consumption purpose or you can use it for savings purpose, right? Yes. So what do you see here? This is the gap between your consumption and income. In the beginning, as you can see, your consumption is greater than your what? Level of income. I'm sorry, denoted with Y. So your consumption is greater than the level of income. At this particular point, your consumption is equal to income. And after this particular point, your consumption is less than the level of income. So this region is the savings region and this region is your dis-savings region. So what they did is they have drawn the leakages lines as well. So what is the leakage happening here? It is the saving that is happening, which is called the leakage. Why is it called the leakage? Because savings kind of reduce the economic activity. If you have to stay in equilibrium, you have to kind of bring in the investments also. So in short run, investments are constant. They are autonomous as well, right? So how do you draw your investment line? Your investment line will be drawn as parallel to x-axis. Okay. So for example, they have also drawn, I am also drawing. So let me draw it here only. Why I draw it somewhere else? Yes. Okay. No, this is not something. How? Just give me a moment. Okay. So I don't think this will suit in this graph. I'll do it in another graph, which can, which I'll be using it to help you understand the equilibrium between investment and savings as well. I will do it separately for you. What I will do it now itself. Why later? Yeah. So let us all do it together. So here I am drawing the graph for your consumption, and consumption line is a bit flatter than your income line, right? This is your consumption line. C is equal to A plus BY, and this is your income line, right? Yes. Now let us draw your savings line. And your savings line will start from the negative axis. Can you please tell me why it is starting from the negative axis? Because in the beginning, what you see is you see dissavings. That is, in the beginning, as you see, your consumption is greater than income. So there is dissaving. That is why your savings line will start from the negative axis, right? Here your consumption is equal to savings. So savings will be equivalent to 0. So savings will be equivalent to 0. So your savings line will start from here. So in this particular region where your saving is happening, your saving is in the negative axis. Here your saving is 0, and after this point your savings is positive, right? So it will go to the positive axis. It will go to the positive axis, right? So this is your savings line. Clear everybody? Very good. Now what we will do is that we will also include something called as your investment, okay? And in your investment, it is independent of the level of income, right? Your aggregate demand is nothing but, I'm so sorry for my nose, I don't know why, but I have some allergy. So your aggregate demand is equal to C plus I. Your aggregate demand is equal to C plus I. I have drawn which line here? Your consumption line. If I add your investment also, that will become your AD line, right? So what I will do is I will also induce your investment line, and I will draw it here. Okay. So I have drawn your investment line as well. This is your C plus I. Your C has moved upwards, right, by a constant amount, which is your I. Your C has moved upward by a constant amount called as I. Okay. This is your C plus I. So I will also draw your injections and leakages in this graph. The graph that I am drawing right now is your injections and leakages graph. Leakage is your savings, injection is your investment. Okay. So I'll draw your investment here, which will be parallel to x-axis because it is independent of the level of income. My graph is parallel to x-axis because it is independent of the level of income. People, wherever your AD is equal to AS, your AD is equal to AS is this point, right? So whenever your aggregate demand is equal to aggregate supply, what do you see here? Your investment is equal to savings. That is, your leakages are equal to your injections. People, whenever you are in equilibrium, your leakages are equal to your injections as well. Okay, that also I just wanted to show you this. For the very reason I have drawn this graph. Clear everybody? Yes. Let us proceed to the next one. So what do they have to tell? Savings function is level of savings at each level of income. At 0 level of income, positive value of consumption. That is the reason I told you that it is your autonomous consumption. Independent of the level of income, you will have some consumption, which is your autonomous consumption. When income is low, C exceeds Y. Whenever your consumption is exceeding your income, you are dissaving. Whenever your consumption is equal to your income, your saving is 0. Whenever your income is greater than your consumption, you are saving. Clear everybody? Yes. So this is your consumption function or your consumption saving function, income consumption function. So let us proceed to the next concept, which is your aggregate demand and aggregate supply. So in a two-sector model, your aggregate demand is nothing but your C plus I, and your aggregate supply is denoted by Y, and your Y is equal to C plus S. Right, everybody? So in a two-sector model, your aggregate demand is equal to aggregate supply, right? What is aggregate demand? C plus I. And what is aggregate supply? C plus S, right? So you can either use it for consumption or you can use it for saving. If you cancel out C, what are you left with? I is equal to S. So your investments is equal to savings when you are in equilibrium. Your investment is injection, your saving is leakage. So your leakages are equal to your injections. You can either show it this way or you can also show it in the with the help of a diagram. Okay. Consumption function. Functional relation. What do you mean by a function? First of all, function talks about the relationship between dependent variables and independent variables. Whenever I say consumption function, you are talking about the relation between consumption and the level of income. Here consumption is your dependent variable, level of income is your independent variable. And what was the consumption equation that we discussed? It is A plus BY. So this discussion we have already completed. Yes. Next, what is your aggregate supply? Your supply is nothing but your aggregate income. So Y is equal to C plus S. So your savings is equal to income minus consumption, right? Your savings is equal to income minus consumption. Your savings is a function of income. Students, remember that Your savings is a function of your income. And what was B when we discussed your consumption equation? B, we called it as MPC. B is nothing but your MPC, right? So what is MPS, by the way, I want to know. MPC is marginal propensity to consume. What is MPS? Marginal propensity to save. What is MPS? Marginal propensity to save. It is nothing but delta S by delta Y. It is nothing but delta S by delta Y. So what do you mean by delta S by delta Y? It is change in savings due to change in the income. Whenever the income is increasing, by what proportion you are increasing your savings? That is told by your MPS. Okay. And students always remember that your MPC plus MPS is equal to 1. Your MPC plus MPS is equal to 1. So what is MPC? It is delta C by delta Y. Plus what is MPS? It is delta S by delta Y. We are just proving how is it equal to 1. Okay. So next, what is delta C plus delta S? What is delta C plus delta S? It is nothing but change in your income. See, delta Y is change in your income. That change in your income can be either used for consumption or used for savings. So it is nothing but delta Y by delta Y, which is cancelling out and coming out to be 1. So MPC plus MPS is equal to 1, right? So always remember that the values of your MPC and your values of MPS will vary between 0 to 1. The values of MPC and the value of MPS will vary between 0 to 1. Okay. So if they are varying between 0 to 1, for example, I say that your MPC is equal to 0.5. What will be the value of your MPS? It will be 0.5. How did you say that? MPC plus MPS is equal to 1. So I told that MPC is 0.5. So MPS will be equal to 1 minus 0.5, which is 0.5. Clear everybody? Yes. So you have to remember the condition that MPC plus MPS is equal to 1 and your MPC is marginal propensity to consume. The formula delta C by delta Y. Your MPS is marginal propensity to save, which is nothing but your delta S by delta Y, right? So can I also write it this way? So MPC plus MPS is equal to 1, right? MPC is denoted by B. So MPS is equal to 1. So MPS is equal to 1 minus B. So MPS is nothing but 1 minus B is nothing but your MPS. Okay. So this is what I wanted to tell you. So we'll continue with what? We'll continue with your savings function. Let us see what they have written. So they said savings is a function of income and savings is equal to minus A plus 1 minus B into Y. So what is this minus A? It is the dis-saving portion. It is the dis-saving portion. And what is 1 minus B? It is your MPS. I have just now shown you, right? 1 minus B is nothing but your marginal propensity to save. So we have completed your MPC, MPS discussions, right? So let us also discuss what is APC and APY. Sorry, APS. So APC is nothing but C by Y. What is the formula for APC? It is the ratio of total consumption to total income. That is on an average you are talking. So how do you get that? It is C by Y. What is APS? It is the average propensity to save. It is nothing but S by Y. It is savings by income. That is what portion of your income are you saving. And what is C by Y? What portion of your income are you consuming? Clear everybody? Yes, this is your APC. This is your APS. And so we were discussing about the two-sector model, right? In your two-sector model, you have got only your consumption expenditure and investment expenditure, ignoring the government expenditure and your foreign sector, right? And whenever you are talking about the investment expenditure in the two-sector model, as we are in the short run, investment is considered to be constant. It is autonomous of the level of income as well, right? So we call it as I bar. So let us see what they have written here. So the two-sector Keynesian model is the simplest representation of the Keynesian economics, excluding your government sector and the foreign sector. So you're only taking the consumption expenditure and the investment expenditure. So equilibrium in the two-sector model. So equilibrium in the two-sector model, just a second. Yeah. So equilibrium level of national income is determined where aggregate demand is equal to aggregate supply. So wherever your aggregate demand is equal to aggregate supply, that is your equilibrium condition. And in two-sector model, your aggregate demand is equal to what? Your aggregate demand is equal to consumption expenditure plus investment expenditure. Your aggregate supply is also called as your what? Aggregate income. So it is denoted by Y. And your level of income is used for two things, which is your consumption and savings. So C plus I is equal to C plus S. So what will happen? Your investment is equal to savings. Your investment is equal to savings, right, everybody? So that is the thing. What else? So they have also presented this in the form of a graph, as you can see here. So in panel A, in terms of aggregate demand and aggregate supply, income is measured on x-axis, your consumption, your savings, your investment are measured on the y-axis. See, what they have done is, they have taken your aggregate demand in the upper graph. In the lower graph, they are talking about the leakages and injections. What is the leakage in your two-sector model? It is your savings, which is considered as leakage. What is the injection in your two-sector model? It is your investment, which is considered as injection, right? So as you all can see, at this particular point, which is your equilibrium, your aggregate demand is equal to aggregate supply and your investment is equal to savings. That is, injection is equal to your leakages. But you also have to see something else. What do you see beyond the equilibrium point? Like beyond this equilibrium point, at point B, you observe that your aggregate supply is greater than aggregate demand. So there is a disequilibrium that you see here, and this disequilibrium is adjusted actually. Okay, so what will happen? Your aggregate supply is greater than aggregate demand, indicates that your C plus S is greater than C plus I. That is, your S is greater than I. If savings are greater than investment, people are not spending, right? So what will happen to the aggregate demand? It will decrease. So what will happen to the aggregate demand? It will decrease. What will happen to the inventories? They will increase. What do you mean by inventories, people? If aggregate demand is not there and your supply is more than the demand, so there are additional units that are not being sold, right? So they are considered to be inventories, right? So inventories keep piling up. So when inventories are piling up, what will happen to the investment? That will also decrease. So you eventually will move towards the equilibrium. Now, if you see at this point, your aggregate demand is greater than your aggregate supply. As you can see, your aggregate demand is greater than your aggregate supply. That is, your C plus I is greater than C plus S. That is, investment is greater than savings. So when investment is greater than savings, what will happen to the inventories? They will decrease. They will decrease. When demand is greater than supply, the inventories will decrease and you will go for additional investment right? So whenever you increase your additional investment, what will happen to the equilibrium level of income? That will increase as well. What will happen to the equilibrium level of income? That will also increase. So whenever there is a disequilibrium, you are moving towards the equilibrium. So what do you see here? All the points on the 45-degree line. See, if you are on the 45-degree line, that indicates that you are in equilibrium. That is, the aggregate demand is equal to aggregate supply, right? So this equilibrium point, whatever you are seeing here, this is on the 45-degree line, which is your aggregate supply line or reference line or your income line. So if you can see, if you are below the 45-degree line, this is your 45-degree line. If you are below your 45-degree line, you can see that aggregate supply is greater than aggregate demand. If you are above the 45-degree line, your aggregate demand is greater than your aggregate supply, right? Since I is constant, in the short run, your investment is taken to be constant, right? So aggregate expenditure schedule, that is C plus I, lies above the consumption by a constant amount. See, this is your A plus BY, that is the consumption function. So if you add investment to it, it will shift upwards. It will shift upwards. So as your investment is independent of the level of income, your consumption function is shifting by a constant amount, which is called as investment. Your consumption is shifting by a constant amount, which is called as your investment, right? So only at point E with output Y0, economy is in equilibrium. Now students, let us focus on something very, very important. See, you are all in Keynes world, right? So is there a possibility for involuntary unemployment or not? There is a possibility for involuntary unemployment. So what Keynes stated was, now at E you are in equilibrium. Correct, I totally agree. But what guarantee is there that this equilibrium is the full employment level of equilibrium? There is no guarantee that this level of equilibrium is your full employment level of equilibrium. This is your potential level of income. No, not at all. So there is a possibility that there is underemployment as well, right? So in panel B, they have plotted your injections and your leakages, which you have already discussed, right? Next, let us discuss this. Equilibrium with unemployment or inflation. I told you, right? In Keynes' world, it is not a mandate that whenever you are in equilibrium, you don't necessarily have to be at the full employment level. So always Keynesian equilibrium AD is equal to AS need not take place at the full employment. What is full employment? You are utilizing all the resources without any underutilization or excess capacity. Because full employment exists only if AD line intersects the 45-degree line at the level of potential GDP. So what is potential GDP? The maximum amount of output that you can produce using all the resources efficiently is your potential level of GDP. That is where there is no recession and unemployment is at its natural rate. So what is natural rate of unemployment, students? Natural rate of unemployment is that which persists in any economy, okay? So it is equivalent to the summation of structural unemployment plus frictional unemployment. So what is natural rate of unemployment? It is structural unemployment plus frictional unemployment. So what is structural unemployment? See, any economies undergo structural changes. That is, until date you are doing the tasks in a manner, and from today you're going to change the task. So there will obviously be unemployment because the workers are not having the required skill set. Okay, that is your structural unemployment. So what is frictional unemployment? Whenever you're shifting jobs, there is some period where you stay unemployed even though you don't want to stay unemployed. That is your frictional unemployment. You don't want to stay unemployed, but still you have to stay unemployed because there is a friction created, right? So that is your frictional. Any economy will witness this structural and frictional unemployment, right? Next, but there is no guarantee that the equilibrium will occur at the potential GDP. This we have been saying from the beginning of the lecture. The economy can settle at any equilibrium which might be higher or lower than the full employment level. Okay. So now listen to me carefully. If you are settling somewhere that is below the potential level of GDP, that is, you could have reached, let me see it here. Yeah. For example, this is what? This is your optimum level of output. For example, what they have did was, they are talking about your deflationary gap. They are talking about your inflationary gap. People, deflation is something that you see when your aggregate level of output, that is your output, whatever output that you're having right now, is less than the potential level of output. Okay. That will happen if you have deficit aggregate demand. Okay. You see deflationary gap or recessionary gap when you have deficit aggregate demand. You see inflationary gap when you have excess aggregate demand. If aggregate demand is in excess, you see inflation. If aggregate demand is in deficit, you see recession, right, everybody? Next, it occurs when the economy is in contractionary phase of the business cycle. Business cycles are nothing but, there are fluctuations in the economic activity, and you typically have 4 phases in your business cycle, which is your expansion, your peak, contraction, and depression. So what is the meaning of contraction? It is the period of falling economic activity. Contraction is the period of falling economic activity. So whenever economic activity is on decreasing trend, your aggregate demand kind of decreases, right? So what do you see in recession? You see deficit aggregate demand during recession. So at the full employment level of output, sorry, if the AD for an amount of output is less than the full employment level of output. So if the aggregate demand is not, whatever full employment level of output you have to reach, for that you require a specific amount of aggregate demand. If right now whatever aggregate demand you are having is not sufficient for you to meet the full employment level of output, then you are under your recessionary phase. Right, then deficient demand exists. This deficient demand gives rise to deflationary gap. If you see the graph, you will clearly understand, students. The OQ star is the full employment level of output. Okay, so if you are actually producing at the full employment, you need to produce OQ star. But right now, what is that you're having is your aggregate demand is this. Your aggregate demand is this. So at this aggregate demand, you are only able to produce this level of output, which is M. So M is less than the full employment level of output. You actually could have produced Q star, but you're only producing M. What is the reason you're only producing M? Because your aggregate demand is less when compared to the aggregate demand that is required for you to achieve the full employment level. So what aggregate demand will help you achieve the full employment level? This dotted line is the level of aggregate demand that will help you achieve the full employment level of output. So as you can see, this dotted line is intersecting your aggregate supply at this point, and this point is your full employment level of output. So what do you observe here? You require Q star F. What is the aggregate demand that you are requiring to achieve the full employment level of output? You require Q star F. But what do you have in hand? You have Q star G. You require Q star F level of aggregate demand. But what do you have in hand? You have Q star G. So the gap between F and G, this is your deficit demand. This is your deficit demand. So you are lacking in this. So there are only two questions you have to pose yourself. How much do I require to achieve the full employment level? How much am I having right now? If whatever you are having right now is less than what is required to achieve the full employment level, you are in deficit. If whatever you are having right now is more than what is required to achieve the full employment level, you are in surplus. Whenever you are in surplus, you will see inflation. Whenever you are in deficit, you see recession, right? So these are the things. Next, let us discuss your inflationary gap. So what are the questions I asked you? What do you require? What do you have? If what do you have is greater than what do you require, then you will be in inflation. If what do you have is less than what you require, you are in deflation. Now you are in inflation, right? So you have excess demand. You are having something that is more than the required amount of demand. So let us see the amount of inflationary gap. So what is it? Q star is your what? Full employment level of output. To achieve this full employment level of output, you require Q star F level of demand. What do you require? You require Q star F level of demand. But what is it you're having is, you're having Q star G. You require Q star F. You're having Q star G. So this is your excess demand. This portion that you're seeing right now in your flower bracket is your excess demand, that you're in excess of what that is required. So this is your inflationary gap. Now there is something some key point that you have to remember here. People always notice that whenever you reach full employment, it indicates that you have actually produced whatever you can. You have exhausted the full capacity. Now, even if the demand is increasing, the only increase that you see is in your nominal variables, not the real variables. That is, as you can see, you are actually at M level of output. You have a feeling that, madam, you said Q star is the full employment level of output. I am at M level of output. So I am greater than what is Q star. I am greater than Q star. That is a good thing. No, why are you feeling sorry about? See, the thing that has happened here is, after Q star, whatever increment in your national income that you are seeing is only due to increase in the prices. What happened here was, supply became constant. At the full employment level of output, your supply became constant. That is, it has become vertical. Okay. Now what happened? Your aggregate demand has increased. Initially, this was your aggregate demand. Now your aggregate demand increased. So what is happening here? The price is increasing, but do you see any increment in the level of output? No. So after the full employment level of output, the supply becomes constant. The supply being constant, if there is an increase in the aggregate demand, that will only foster an increase in the prices. So whatever increment in the income that you are seeing is the nominal increase, not a real increase. Okay. So those are the things I wanted to just memorize for you. So as you can see, in the Keynesian model, neither wages nor your, one second. So in the Keynesian model, neither wages nor interest rates will decline to automatically adjust to the market conditions. So okay, let me just take you back to some things. According to classical economists, your wages, your prices, your rate of interest are very, very flexible. So why are they flexible? They are flexible for the very reason because classicals believe that the market is self-adjusting. And for market to self-adjust, you need to have whatever things that I have told you right now to be highly flexible. But according to Keynes, who is, living in the short run, he said the wages, prices, interest rates, whatever you are talking about are not really flexible. They are actually rigid. So the market cannot really self-adjust. That is what Keynes has told. So what is that you have to remember here? According to classicals, your prices, your wages, your rate of interest are flexible, which actually makes the market, sort the disequilibrium, whatever it is encountering. But according to Keynes, whatever variables that I have told you right now, they are not actually flexible. They are actually rigid. which is the reason why your market is not very self-adjusting and Keynes has required for government intervention. Clear everybody? So this was few things with regard to your two sector model. Now what we will do is we'll discuss something called as multiplier. We'll discuss something called as multiplier. I will make you understand multiplier with the help of a graph. So as you can see, this is your income line or your reference line, nothing but your aggregate supply line, right? So your aggregate supply is denoted by Y, and your income can be used either for consumption or for savings, right? Now this is your aggregate demand line. This is your aggregate demand line, which is equal to C plus I. What is your aggregate demand line? It is equal to C plus I, sorry. Now, what happened was we have increased your aggregate demand. What it did is we have increased your investment, let us say for suppose. So, you have a fresh aggregate demand. Okay, this is a bit cross. Let us use another color. Yeah. So, your aggregate demand shifted upwards. This is AD is equal to C plus I bar. Okay. This is I bar, this is I1 bar. Okay. So what happened? There was an increment in the investment and your aggregate demand shifted upwards. So you notice something very unique here. Your investment increased by this amount. This is the change in the investment. Agreed? This is the change in the investment. But what is the change in the income that you see? You see a larger change in the level of income. That is, with a small increment in the investment, if you see a large change in the income, this is the change in the income. As you can see, change in the income is greater than change in the investment. As you can see, your change in the income is greater than change in the investment. This is your multiplier. This is your multiplier. So what is your multiplier? It is change in the income due to change in the investment. What is multiplier? Change in the income due to change in the investment. Your multiplier is denoted by small k. Your multiplier is denoted by small k. So what will be the change in the income? It will be k times delta I. It will be k times delta I. Now what is the how do you calculate your multiplier? Your small k is equal to 1 by 1 minus MPC. Your small k is equal to 1 by 1 minus MPC, which is your multiplier. To be more precise, this is your investment multiplier because you're calculating the change in the income due to change in the investment, right? So this is your investment multiplier, which is 1 by 1 minus MPC. How did I get this 1 by 1 minus MPC? Let us do it. So you all know that at equilibrium, aggregate demand is equal to aggregate supply. You all know that aggregate demand is equal to aggregate supply. You denote your aggregate supply by Y. You denote your aggregate demand by C plus I. You denote your aggregate supply by Y and you denote your aggregate demand by C plus I, right? So how do you write C? It is nothing but A plus BY. Your consumption equation is A plus BY and I is autonomous, right? So I bar. I is autonomous, so I bar. So plus I bar. So you have Y common here. So can I write it as Y minus BY is equal to A plus I bar, and I will take Y common. 1 minus B is equal to A plus I bar. Now Y is equal to 1 by 1 minus B into A plus I bar. Yes, clear everybody? Now I'll split it. So Y is equal to A by 1 minus B plus 1 by 1 minus B into I bar, right? So if I want to understand what is the change in the income due to change in the investment, can I differentiate? I will go for partial differentiation. So let me say dou Y by dou I is equal to change in the income due to change in the investment. So the remaining all aspects will be considered to be constant. So this is considered to be a constant. So differentiating a constant will be 0 plus 1 by 1 minus B. So what is your investment multiplier? It is 1 by 1 minus B. What is B, people? It is nothing but your MPC. 1 by 1 minus MPC. So this is how I got your investment multiplier. Clear everybody? Yes. So these things you have to remember. And some other things that you have to remember is, according to Keynes, your values of the MPC will vary from 0 to 1. But he said that they will be greater than 0.5. This is very, very important. According to Keynes, the value of MPC will vary from 0 to 1, but the value will be greater than 0.5. That is something that he has told. Okay. Now let us discuss something else. So you got your investment multiplier to be 1 by 1 minus MPC. MPC values vary from 0 to 1. If MPC is 0, then the multiplier will be equal to 1. If MPC equal to 0, multiplier will be equal to 1. If MPC is equal to 1, multiplier equal to infinity. If multiplier equal to infinity. So when will multiplier be equal to infinity? If MPC is equal to 1, then your multiplier will be equal to how much? It will be equal to infinity. Clear everybody? Yes. So what is the relationship between your MPC and multiplier? They have what relation? They have an inverse relation. If MPC decreases, multiplier increases. If MPC decreases, multiplier increases. If MPC increases, multiplier decreases. Now you tell me if I am right or wrong. Now you tell me if I am right or wrong. Okay. So I'll give you 2 minutes time, or you can pause the video and analyze whatever I have told you right now. You have to tell me if I am right or if I am wrong. Okay. Think and tell me. I have already written that your multiplier is nothing but 1 by 1 minus MPC. So I have written that if MPC is increasing, your multiplier is decreasing. If MPC is decreasing, your multiplier is increasing. So whatever I have written here is a big blunder. Okay. Your MPC and your multiplier have a direct relation. Your MPC and your multiplier have a direct relation. MPC increase, multiplier increase. People, if MPC is decreasing, your multiplier will decrease. I wrote your multiplier to be 1 by 1 minus MPC. So can I write it as 1 by MPS? Okay. When MPS is increasing, multiplier will decrease. When MPS is increasing, multiplier is decreasing, because this is a leakage. MPC is an injection. So when injections are increasing, multiplier will increase. When leakages are increasing, multiplier will decrease. So this is the concept of your multiplier. Next, everybody. So we'll discuss something else, which is your multiplier shows how shocks to one sector are transmitted throughout the economy through the ripple effect of water. So what is happening here? I told you that whenever you are increasing the investment, your income is increasing more than the increase in the investment. So what is happening here? When you increase the investment, what happened? Your aggregate demand increased, right? So when your aggregate demand has increased, what happened to the investment? That also increased. When your investment has increased, you started hiring more number of people and you kind of created more employment opportunities. When you created more employment opportunities, what is happening to the incomes of the people? Increasing. If incomes of the people are increasing, what will happen to the demand? It is increasing. So as you can see that this process is going on happening. This process is going on happening like a virtuous cycle of prosperity, right? So this is called as the ripple effect of water. This is called as the ripple effect of water. So as you can see, assume in a two-sector model, the economy is in equilibrium and the autonomous investment increases by 500 units. But the increase in income that you see is more than 500 units, right? So what is the reason behind this? An upward shift in the aggregate demand leads to an increase in the income and equal to increase in disposable income. Firms experience increased demand, increase their output. The process further continues as an autonomous rise in investment leads to induced increase in the consumer demand. That is what I am telling you. So whenever you are increasing your investment, the employment opportunities are increasing, income levels are increasing, consumer demand is also increasing. So you are kind of actually posing an impact in other sectors as well, creating a ripple effect of water. Right? So what is the impact of leakages on the multiplier? See people, always remember that injections will increase the multiplier, leakages will decrease the multiplier. Leakages means what? They kind of cause a fall in the economic activity. When there is a fall in the economic activity, what will happen to the multiplier process? It will die down. It will die down. Okay. So this is very, very important. You have to remember this equation. So how did I get this? How did I get this? Because you people learned that C is equal to A plus BY. You learned that C is equal to A plus BY. So how did I get this? This is even right or wrong? So let us see how did we get this. Okay. So Y is equal to C plus I. Y is equal to A plus BY plus I. Y minus BY is equal to A plus I. Y is equal to 1 by 1 minus B into A plus I. So what is the value of I that you got? 1 by 1 minus b into a plus I. What is C? C is equal to a plus by. Substitute y in C, which is equal to a plus b by 1 minus b into a plus I. Simple. Okay. So this is how you got this. This is how you got this. Clear, everybody? So what did I do here? I have just substituted the value of y that I have obtained in your consumption function, which has given me a plus b by 1 minus b into a plus I. Yes. Next, people. So we'll continue with the three sector model. We'll continue with the three sector. So students, let us continue with your three sector model. So what is your three sector model? You have C plus I plus G. That is, you include government expenditure, but you exclude the foreign sector, right? So what do you see here? In the Keynesian three sector model, AD consists of household consumption plus your business investment and your government sector's demand for goods and services. So here, what are you not including? You are not including the foreign sector. So what are the assumptions that we are taking? Investment and government expenditure are constant. So I told you, right, your investment and government expenditure are independent of the level of income. So you denote them with I bar and G bar. You denote them with I bar and G bar. Next, there is also no foreign sector. Next, prices are fixed, all are real variables. So what do you see here is that you are in short run, right? You are in which run? You are in short run. And according to Keynes, the prices are rigid. According to Keynes, the prices are rigid. So whatever increase you see, that is the increase in the real variables, right? So at equilibrium, what do you see? Your aggregate demand is equal to aggregate supply. Your aggregate supply, also called as your aggregate income, is denoted by Y. So Y is equal to C plus I plus G, right? So what do you see here is, let us see it in a graph which will make the things even more easy. So what I will do is, in panel A, I will draw your aggregate demand. In panel B, let us see your leakages and injections. Okay. So what do you do here is, please draw first your 45-degree line, which is nothing but your reference line or your aggregate supply line, right? So Y is equal to C plus S plus T. What is this T? See, your income can be spent either for consumption, either for savings or for taxes, right? Now you have your aggregate demand line, which is C plus I plus G. What is your aggregate demand? C plus I plus G. So at equilibrium, your aggregate demand is equal to your aggregate supply. What is your aggregate demand? C plus I plus G is equal to C plus S plus T, which is your aggregate supply or your aggregate income. So if you cancel out your C's, your I plus G is equivalent to S plus T. Your I plus G is equivalent to S plus T. So what is I plus G here? They are your injections. I already taught you, right? Your investment and government expenditure are considered to be injections. Savings and taxes are considered to be leakages. So what do you see? At equilibrium, your injections are equal to your leakages. Your injections are equal to your leakages. So what we will do is, let us draw your leakages injections graph as well. Fine. So you guys know that, you already know that this is your savings line. This is your savings line, but this is also your leakages line now. You have not only savings as leakages, but also you have taxes, right? So this is your S plus T, and they are directly related with the level of income. They are directly related with the level of income. So as income increases, your savings increase, and as we follow progressive taxation, your tax liability will also increase, right? So what is happening here? Let us draw another line. So let us say this is your I plus G. This is your I plus G. Fine. So this is your injection. I plus G is nothing but your injection. I plus G is your injection, right? So whenever you are in equilibrium, you just have to draw it this way. It has to come a bit like this, okay? So whenever you are in equilibrium, that is whenever aggregate demand is equal to aggregate supply, your I plus G is equal to S plus T. I have proved it here, right? That is what we are planning to show it in the graph as well. So whenever AD is equal to AS, your injections are equal to your leakages. Here in the three sector model, the injections are I plus G, the leakages are S plus T, right? So if you are below the 45-degree line, what do you see here? You see aggregate supply greater than aggregate demand. So your S plus T will be greater than I plus G. That is, leakages will be greater than the injections. Whenever leakages are greater than injections, what will happen to the income? It will decrease. And here, as you can see, whenever you are above the 45-degree line, your aggregate demand is greater than your aggregate supply. So I plus G is greater than your S plus T. Here, as you can see, your injections are greater than the leakages. Here, what do you see? Your injections are greater than the leakages. So whenever your injections are greater than the leakages, you see a rise in the economic activity. So income will increase, right? So whenever disequilibrium is there, that is set out. So whenever disequilibrium happens, that is corrected by, adjustment of your income. So if aggregate demand is greater than aggregate supply, injections are greater than leakages, leading to an increase in the income, and you will be approaching the equilibrium level. Whenever supply is greater than demand, leakages are greater than your injections, there is a decrease in the level of income and you are approaching the equilibrium level of income. Okay, so let us see what they have written here. Taxes on households, business sector used to fund the government purchases. So the taxes that we are talking here are your what? They are your leakages. So that leakages are being injected back into the economy in the form of government purchases. Government borrows from financial markets. See, there are chances where your government expenditure can be exceeding the government revenue, right? So what will be the government doing then? It will be borrowing some money. Next, two leakages that household sector have are savings and your tax payments. And what are the injections that you have? You have your government expenditure and you have your investment, right? Next, this is the graph that they have shown here. So in panel A, what did they show? They showed your aggregate demand. So they first drew your consumption function, which is C is equal to A plus BY. Later they added investment. Investment is an autonomous component, right? So yeah, as you can see, your aggregate demand shifted upwards by a constant amount, which is I. Now we are also including G because we are in the three sector model. So again your C plus I have shifted upwards by a constant amount, which is your government expenditure, right? So whenever you are in equilibrium, that is C plus I plus G is equal to your aggregate supply, that is aggregate demand is equal to aggregate supply. What do you see? You see that your I plus G is equal to S plus T. Your I plus G is equal to S plus T. That is, your injections are equal to your leakages. That's it. Next, this everything we have discussed. So what we will do right now is we will derive these different formulas. Okay, people, this is very, very important, which you have to memorize. Okay, all these things that you are witnessing here, you have to memorize. So what have they written here? At equilibrium, your aggregate supply is equal to aggregate demand. So as government is present, you also have something called as taxes, right? So for taxes, they have given T bar plus Ty. So let us understand what is the meaning behind this. See, T bar is autonomous taxes. T bar is autonomous taxes. See, what are autonomous tax or lump sum tax, to be more precise? Your T bar is your lump sum tax. What is your lump sum tax? Irrespective of the level of income, you will be imposed by this lump sum tax. So you are not connecting with the level of income. Now this small t that you see here is your proportional tax. So this is your lump sum tax. And this is your proportional tax. This is your proportional tax. Clear, everybody? So you have two types of taxes. One is the lump sum tax, which is independent of the level of income. The other is the proportional tax, which is related to the level of income, right? So we have to take that into consideration as well when you are calculating the disposable income. I will show you how do you do that. Fine. Next. So whenever you have a lump sum tax, what will be the value of the multiplier? Whenever you have lump sum tax and proportional tax, what will be the value of the multiplier? If you don't have lump sum tax, proportional tax, what will be the value of the multiplier? So all that they have written here. You have something called as transfer payments. People, whenever we are calculating the disposable income, you also take into consideration the transfer payments. So what are transfer payments? Transfer payments are one-way traffic, right? The unemployment benefits or the pensions or the scholarships that you keep receiving from the government are considered to be transfer payments. See, they are not received on behalf of some productive activity, but they are just coming into your hands without you even earning them, right? So that is the reason they are considered to be transfer payments. And whenever you are calculating your disposable income, you have to take into consideration taxes. You have to take into consideration the transfer payments as well, right? So how do you do that? That we'll have a look just now. Okay. So yeah. So after doing this, we will proceed with the four sector model, and you have your foreign trade multiplier. After that, we can end the lecture and we can proceed to do some problems. But before that, my request is please take out your notebooks so that you can write things down. So let me write the, things for you, like what are the things that we are considering. So first of all, we are talking about the three sector model. So here your AD is equal to AS indicates, Y is equal to aggregate supply, aggregate demand is equal to C plus I plus G. At equilibrium, aggregate supply is equal to aggregate demand. So Y is equal to C plus I plus G. Okay. Yes. So what is your, tax equation? T is equal to T bar plus small t y. T is equal to T bar plus small t y. So your taxes are a summation of lump sum tax and as well as proportional tax. And what does TR denote? They denote your transfer payments. What is your consumption equation? Which is C is equal to A plus B y D. Your consumption is a function of disposable income. So what is disposable income? It is Y minus taxes plus transfer payments. Your YD is equal to Y minus taxes plus transfer payments. Like after deducting the taxes, after adding the transfer payments, what you are left with is your disposable income. That is the money that is available for you to spend. Okay, everybody? Yes. Let us write down your things. So Y is equal to A plus B into Y minus, what is your equation for taxes? Minus T bar minus small ty plus, this is your C, plus I bar and your G bar. I bar and G bar indicates they are your autonomous components or independent of the level of income. They are constant in the short run, right? So multiply this. Y is equal to A plus by minus bt bar, sorry, minus bty plus, okay, we forgot to add transfer payments, students. So add your transfer payments as well, plus btr plus I bar plus G bar. Okay, so plus I bar plus G bar. So take all the y terms on one side. So y minus by plus bty, y minus by plus bty is equal to a minus bt bar, what else, plus btr plus I bar plus G bar. Okay, so this is your thing. Next, take y common, y into 1 minus b plus bt is equal to a minus bt bar plus btr. This is also autonomous, okay, plus I bar plus your G bar. Now take b also common, 1 minus b into 1 minus t is equal to a minus bt bar plus btr bar plus I bar plus G bar. Okay, so y is equal to 1 by 1 minus b into 1 minus t into a minus bt bar plus btr bar plus I bar plus G bar. Okay, this is the thing that you have. This is the thing that you have. And whatever you are seeing here right now is your multiplier. Whatever you see here is your multiplier. See people, you have an equation here. Your income is being influenced by your lump sum tax, by transfer payments, by investment, by government expenditure. Now we only want to understand what is the change in the income due to change in the investment. What is the change in the income due to change in the investment? Okay, this will become your investment multiplier. So what is it? 1 by 1 minus b into 1 minus t. You just have to do the differentiation here. Okay, you just have to do the differentiation. Now what is dou y by dou g? It is government expenditure multiplier. That is change in the income due to change in the government expenditure is nothing but your government expenditure multiplier. So this will be 1 by 1 minus b into 1 minus t. Right, students? Now, what is your transfer payments? So, change in the income due to change in the transfer payments is b by 1 minus b of 1 minus t. What is your lump sum tax multiplier? It is dou y by dou t bar, which is minus b by 1 minus b into 1 minus t, which is minus b by 1 minus b into 1 minus t. So, these are the different multipliers that you have got. See, whatever method I have shown you right here, the same method you have to apply while you are doing your foreign trade multiplier. Okay. So, the same method you have to apply for your foreign trade multiplier. This is a very, very simple thing. What you have to do is, you just have to do the differentiation after you kind of, bring out these things. Like if I only want to know what is the change in the income due to change in the investment, I keep the remaining things constant. If I only want to know what is the change in the income due to change in the transfer payments, remaining things are taken to be constant. So that is how you do the thing. So as you can see, these are the different multipliers. Okay. So this we have already done. So you got your 1 by 1 minus b of 1 minus t. But if you don't have any taxes, be it your lump sum tax or your proportional tax, what is the government expenditure multiplier? 1 by 1 minus b. The same like your investment multiplier that you got in your 2-sector model, right? So let us proceed to your 4-sector model. In your 4-sector model, you have a foreign sector. So it is y is equal to c plus I plus g plus x minus m. So what is your foreign sector? It is C plus I plus G plus X minus M. You are also taking into consideration the net exports here, right? So people, just listen to me carefully. So whenever you are talking about exports and imports, in exports, your exports are your injections and imports are your leakages. So what are the list of leakages that you have? Your savings are a leakage, your taxes are a leakage, your imports are a leakage. Now, what are the list of injections? Your government expenditure, the level of investment, and exports are considered to be the injections, right? So, whenever you are in equilibrium, that is whenever aggregate demand is equal to aggregate supply, the injections are equal to your leakages. So, what will you get? You will get S plus T plus M. What are these leakages? Is equal to I plus G plus X. These are your injections, right, everybody? This is what you will be getting in your 4-sector model. So let us see this. So as you can see, S plus T plus M, this is plus, S plus T plus M is equal to I plus G plus X. So you are in equilibrium when aggregate demand is equal to aggregate supply. So if you are above the 45-degree line, what do you see? If you see that aggregate demand is greater than aggregate supply. If you are below the 45-degree line, aggregate supply is greater than your aggregate demand. Clear, everybody? So here what you have to remember is your foreign trade multiplier. Here what do you have to remember is your foreign trade multiplier. So what is the foreign trade multiplier? I will just take you through that. Your foreign trade multiplier is nothing but, this is your foreign trade multiplier, right? It is 1 by 1 minus b of 1 minus t plus m. It is 1 by 1 minus b of 1 minus t plus m. If you don't have the proportional tax, your foreign trade multiplier will be 1 minus b plus m. If you don't have a proportional tax, your foreign trade multiplier will be 1 by 1 minus b plus m. Okay. So if what will I do is, I will just do this also so that you can have some clarity. So let me do this. So before that, you need to learn this as well. Your imports equation is your m bar plus my. So what is small m? It is marginal propensity to import. What is small m? It is marginal propensity to import. What is your m bar? It is autonomous imports. That is your independent of income. Okay, what is M bar? Autonomous imports, which is independent of the level of income. MPM is your marginal propensity to import. Clear, everybody? Yes. And your X is autonomous again. X is considered to be constant, X bar. Okay. So what we will do is, we'll calculate your foreign trade multiplier as well, so that things will be easy for you. So as you can see here, it is 1 by 1 minus b plus m. If I open the bracket, if I don't, it is 1 by minus of b minus m. Right? It is simple as that. Okay, what I will do is, I will calculate this multiplier for you so that you can understand. So as you know, even in a 4-sector model, the equilibrium condition is aggregate demand is equal to aggregate supply, right? So Y is equal to C plus I plus G plus X minus M, right? Yes. So X is autonomous, so I'll write X bar. So Y is equal to A plus B YD plus I bar plus G bar plus X bar minus of, it is M bar plus small m y. It is M bar plus small m y. So Y is equal to A plus B YD plus I bar plus G bar plus X bar minus M bar minus small m y. So take all y's on one side. It is y minus by plus my is equal to a plus I bar plus G bar plus X bar minus M bar, right? So if you take y common, it is 1 minus b plus m is equal to a plus I bar plus G bar plus X bar minus M bar. Okay. So if you take y is equal to 1 by 1 minus b plus m into a plus I bar plus G bar plus X bar minus M bar. Now if I want to calculate the the foreign trade multiplier, it will be this. It is foreign trade multiplier is equal to 1 by 1 minus b plus m. That is, if you take dou y by dou x, it will be 1 by 1 minus b plus m. If you take dou y by dou m, it will be minus 1 by 1 minus b plus m. So this is your foreign trade multiplier. Clear, everybody? So this is the thing. So what they have done is they have taken the minus sign common. So if you will get my 1 by 1 minus of b minus m. These are the things that you have to remember in your what 4-sector model. So thank you, students. What we have done right now is we have completed your chapter. We have completed your chapter entirely. So you just take a look at these multiplier things. Okay. So just remember that in a 2-sector model, it is the multiplier formula is 1 by 1 minus MPC. In a 3-sector model, if you don't take the proportional tax and the lump sum tax, it will be 1 by 1 minus MPC. If you take the proportional tax, I already showed you the calculation, and your simple foreign trade multiplier is 1 by 1 minus B plus M, or 1 by 1 minus of B minus M. So for you to attain some confidence, what we will do right now is we will do some problems. We will do some problems so that you will be familiar with the concepts, so that you can attain some surety that, okay, I've listened to the lecture and I'm actually able to apply the things. Fine. Hello students, welcome back to another session of Economics for Finance. So in this session, we'll be discussing the chapter Monetary Policy. Like all the other chapters, we are going to complete this chapter in a span of 1 hour or 1.5 hours, so that you will be able to answer all the questions asked, right? So let us jump into the chapter. So let us understand first what is the meaning of monetary policy. So what is the meaning of monetary policy? Monetary policy refers to the use, monetary policy, just give me a moment. Monetary policy refers to the use of monetary policy instruments by the central bank to regulate the availability, cost and use of money, credit to promote the economic growth. People, just listen to me carefully. Who is the Central Bank of India? It is Reserve Bank of India. So at Reserve Bank of India's consideration, you have got large number of instruments which the RBI uses to regulate the money supply and to, control the economic activity or control the inflation in the economy. So those instruments are categorized into qualitative instruments and quantitative instruments, which you will be learning in this particular chapter, right? Next, so how do you regulate the cost of money? See, whenever you are increasing the supply of money, you see a fall in the rate of interest. So the cost of borrowing for the people will decrease and more people will be willing to borrow the money, and the economic activity will kind of increase, right? So there are two types of monetary policy an RBI can adopt, that is our central bank, which is expansionary monetary policy and contractionary monetary policy. The meaning of expansionary monetary policy is the RBI is trying to reduce the money supply. The meaning of contractionary monetary policy is reducing money supply. The meaning of expansionary monetary policy is increasing the money supply. So what is it, students? Expansionary monetary policy is increase in money supply. Contractionary monetary policy is decrease in the money supply. Right, everybody? Next. Let us understand the monetary policy framework. So it has got three basic components. One is the objectives of monetary policy. See, our objective is what? The objective of the Reserve Bank of India is inflation targeting. That is to put the inflation or to maintain the inflation rate between 2% to 6%. And the average rate of inflation that must prevail in the economy is about 4%. So every central bank has got some objectives that it works on, right? Now, what is the second point? It is the transmission mechanisms of monetary policy. What is it? Transmission mechanisms of monetary policy. See, whatever decisions the central bank is taking, how are they being transmitted to the grassroots level? So, you have got the commercial banks in between who are acting. So, what are the different transmission mechanisms that are used to pass on the monetary policy initiatives taken by the central bank to the grassroots level? Next, what operating procedure? See, operating procedure is nothing but day-to-day activity to meet these targets. Whatever the targets have been set by the central bank, if you have to meet them, what are the day-to-day activities that you are performing is nothing but your operating procedure. So what are operating procedures, students? They are the day-to-day activities performed to achieve the monetary objectives, right? So let us understand what are the objectives of monetary policy. So what we are going to do in this chapter is, we are going to see all these three things. We are going to see all these three things. That is the objectives of the monetary policy, the transmission mechanism, and the operating procedure. Fine. So let us start with the objectives of monetary policy. So what is the primary objective of monetary policy? It is maintenance of a judicious balance between price stability and economic growth. See, any central bank, or in our case, it is the Reserve Bank of India, right? So the objective is maintaining a stable growth and maintaining stability in the prices. That is, inflation has to be moderate, right? Next, what else? What are the explicit objectives of monetary policy of a developing economy? So what are the explicit objectives? See, our main objective is focusing on price stability. Like I have always told you that inflation targeting is the main objective of your Reserve Bank of India. And what is the target? What is the band that we have given? It is 2% to 6%. What is the average? It is 4%. So there are also other objectives which the RBI has to achieve, which are maintenance of the economic growth, ensuring an adequate flow of credit to the productive sectors. See, whose responsibility is it that credit flow is ample in the economy? It is the responsibility of Reserve Bank of India. Next, sustaining a moderate structure of interest rate to encourage the investments. So, it is the responsibility of Reserve Bank of India again to encourage investments in the economy, and for investments to be encouraged, or rather if investments have to be pushed up, it is the interest rate that they have to maintain, so that investments are kind of ample in the economy and the economy sees a rise in the economic activity. And who actually can change the interest rates? It is the Reserve Bank of India. How can they change the interest rate? Through their monetary policy initiatives. Next, creation of an efficient market for government securities. See, the purchase and sale of government bonds is taken care by the Reserve Bank of India. You people might have heard of the terms called treasury bills, government bonds, or government securities, right? So whenever you're hearing the term treasury bills, it indicates that they are issued for a period that is less than 1 year. Treasury bills are short term in nature. Government bonds or government securities are long term in nature. Clear, everybody? So less than 1 year is short term, more than 1 year is long term. So what are these government bonds? See, it is not always that the revenue is greater than the expenditure. Most of the cases, or rather can I say in almost all the cases, the government expenditure will always be greater than government revenue. So to meet that deficit gap, the government kind of borrows money and it uses an instrument called as government bonds. Okay. And the sale and purchase of government bonds has to be taken care by the Reserve Bank of India. See, like it is the banker of the government, right? So all the activities of the government have to be taken care by the Reserve Bank of India, right? Next, so what are the other objectives of the Reserve Bank of India? Can you please revise? Or rather, any central bank of a country? They must maintain stable economic growth. Stability in prices is the primary objective. So they have to maintain moderate inflation. And what is our objective? Inflation targeting, right? So what are the other objectives? Ample, money supply has to be created, ample credit has to be created so that investments are encouraged, and the government securities are also dealt by the Reserve Bank of India. That is, the sale and purchase of government securities are also dealt by the Reserve Bank of India. Next, what are the objectives of monetary policy of India? That is RBI Act 1934. You know, the Reserve Bank of India has been established under the RBI Act 1934, right? So what are the aims of your Reserve Bank of India? See, any institution, if it is established for a particular purpose. So what is the purpose of our Reserve Bank of India? That is to regulate an issue of banknotes. See, the authority to print and issue currency is with the Reserve Bank of India. Barring 1 rupee coins and 1 rupee notes, which is handled by the government of India, the remaining is taken care by the Reserve Bank of India. Maintaining reserves to secure monetary stability. So what is this? India follows minimum reserve system. That is, whenever RBI is having a reserves which are worth 200 crores, of which some portion has to be maintained in terms of gold and in terms of foreign currency. If you are maintaining this minimum reserve, you are able to print unlimited currency. Okay, you are getting the eligibility to print unlimited currency. For example, you want to print 1 crore rupees. You want to print, the RBI wants to print 1 crore rupees. So the basic thing that is it has to fulfill is it needs to have a minimum reserve of 200 crores. And I'm talking about this 200 crores should comprise of gold and foreign currency, right? And the prices are 1962 prices. Okay, this 200 crores, I'm talking in terms of 1962 prices, because it is from 1962 that we started following this minimum reserve system. Now for printing 1 crore, the basic condition that you need to fulfill is you need to maintain a minimum reserve of 200 crores. This has given you the eligibility to print your unlimited currency. Now to print or to release this 1 crore, you need to print double the amount. That is, you need to print 2 crores. In that, 1 crore can be issued and the remaining 1 crore has to be maintained in terms of foreign currency reserves. That is, this 1 crore is backed by foreign currency reserves, which has to be maintained by the Reserve Bank of India. Next, that is the thing that they are saying here. So why do you do this? This is done to attain stability, right? So that your currency will hold some value. Next, to operate the currency and credit system of the country to its advantage. So who regulates the money supply in the economy? It's the Reserve Bank of India. So money supply can control the rate of interest, and rate of interest determines the demand for credit and supply of credit. So this is how your RBI is trying to influence the economic activity through their monetary policy. And there are two types of monetary policy, like we have discussed earlier. There is expansionary monetary policy and there is contractionary monetary policy. During times of inflation or rising price level, the RBI resorts to contractionary monetary policy. During recession, that is falling economic activity, the RBI resorts to expansionary monetary policy. Now, let us discuss the second step, which is the transmission mechanism of the monetary policy, right? So what is this monetary transmission mechanism? What is the meaning of monetary transmission mechanism? It is nothing but the channels through which the monetary aggregates affect the aggregate output, employment, price level. See people, RBI is kind of controlling the monetary policy. What is the goal of the RBI? Through monetary policy, it wants to influence your aggregate output, level of employment and price level. And to influence these three things, in between there are few institutions that are helping RBI to achieve their targets. So that is nothing but monetary transmission mechanism. Now, transmission of monetary policy, it can be summarized in two stages. What are those two stages? They are changes to monetary policy affect the interest rates in the economy. That is what I am telling you. If you go for an expansionary monetary policy, the RBI is kind of increasing what in the economy? Money supply in the economy. Whenever there is an increase in the money supply, whenever money is easily available, the rate of interest will decrease, right? The rate of interest will decrease. And whenever the RBI follows contractionary monetary policy, that is, it sucks out additional money from the economy or excess money from the economy, money is not easily available for the people. So what will happen to the rate of interest? It will increase. So through monetary policy, your RBI is kind of influencing the interest rates. Next, change in the interest rate affect the economic activity and inflation. So how is change in the interest rate affecting economic activity and inflation? Let us take two examples here. See, what is the first thing that has happened? Through monetary policy, what has been affected? Interest rate. Now, interest rate is posing an impact on the economic activity and inflation. How is it posing an impact on these two things? Take investors for example. See, if anybody want to invest, they're not having their own funds, right? They will definitely borrow some money. And whenever you want people to borrow money, the rate of interest has to be low or high. It has to be low. So whenever the rate of interest is low, more people borrow and more economic activity is generated, right? So interest rate has an impact on the economic activity because based on the interest rate, people decide whether to borrow or not to borrow. Now let us take households as an example. As the rate of interest is low, the households are borrowing more and demanding more goods and services. As they are demanding more goods and services, if supply is matching demand, that is all fine. If the demand is greater than supply, what do you see in the economy? You see inflation in the economy. What is the meaning of inflation? Inflation is nothing but rise in the general price level. What is the meaning of inflation? Rise in the general price level. I hope I made myself clear. So monetary policy affected the interest rates. Interest rates affected your economic activity and inflation. Next. So let us understand. This process is complex and uncertain in timing, and size of the impact on economy is unpredictable. So let us understand the different channels of monetary policy transmission. So the first channel that you see here is the saving and investment channel. Saving and investment channel. Okay. So what is it happening here? If the interest rates on bank deposits are reduced by the central bank. See, what do you mean by bank deposits? People, rather than holding money with themselves, they are putting money in the banks, in the saving account, in FDs, vagera, vagera. The reason why they are putting money in their banks is nothing but because they are earning something called as the rate of interest. So rate of interest is something that is motivating people to put their money with the banks, right? So what is happening if the rate of interest is reduced? If the rate of interest on deposits is reduced, people will lose the incentive to deposit the money. They will feel, Are Baba, if it is there in the bank or there with me, what difference is it making? So what will happen to the savings? Household savings will decrease. When household savings are decreasing, that is more people are holding money with themselves. See, you will not hold the money for no reason, right? You will kind of demand goods and services. So what will happen to the household consumption? That will increase. When household consumption is increasing, what is happening? Economic activity is also increasing. So what is happening here? When the rate of interest has declined on the deposits, more people are not saving. So more people are holding the money with themselves. So what is happening to the spending? The spending is increasing and you see an increase in the economic activity. Clear, everybody? Now, this is from whose side? This is from depositor side. Now let us talk from investor side. If the interest rates on loans reduced by the central bank. So if cost of borrowing, what is interest rate on loan? It is nothing but cost of borrowing. What is interest rate on loan? It is nothing but cost of borrowing. So if cost of borrowing is reduced, households will borrow more money. Investors will also borrow more money. See, when they are borrowing more money, what will happen to the economic activity? That will also increase, right? So let us see the point here. Low repayments make the households borrow. So when the rate of interest is decreasing, the cost of borrowing is decreasing. People feel like borrowing more amount of money. So demand for assets such as housing investments increase. See, I want to construct a house and I want to take a loan, housing loan. See, I will take a housing loan if the rate of interest is really, really less. That will actually, make me, feel like I want to build my house. So what will happen? The housing investment. See, households, in which areas do they invest? They go for residential investments. Household, where do they invest? They go for residential investment, right? So what happens to the residential investment? It will increase. Next. Businesses. Low cost of borrowing make businesses to invest. If returns on these projects, see, whenever you are kind of investing somewhere, you analyze two things. One is, what is the cost of the project? What will be the return on the project? If the return on the project is more when compared to the cost on the project, you will definitely go ahead with the project, right? So what is happening here? If returns on these projects are greater than cost of borrowing, firms use debt rather than business owners' funds. So what will happen now? So if the cost of the borrowing is less than the return, for example, the cost of the borrowing is 8% and the project is giving you a return of 10%. You are making a profit of 2%. Would you borrow or would you not borrow? You will definitely borrow because you are on a profit side, right? Next, the next channel that you see here is cash flow channel. I hope you understood the saving and investment channel. So we actually spoke from depositor side. We actually spoke from lender side as well. So we actually spoke from depositors, that is who are depositing their money, and from the people who are borrowing the money. So whenever there is a fall in the interest rate, lesser people will save, and whenever there is a fall in the interest rate on loans, more people will borrow. So these are the two things that you need to remember. Now, cash flow channel, availability of cash with households and business. So income to households and businesses decrease. So what is happening here? If the rate of interest on bank deposits is reducing, I have put my money in the banks, right? I have deposited my money with the banks. So if the rate of interest is decreasing, the interest income that I am getting is decreasing or increasing? It is decreasing. When rate of interest is decreasing, households and business spending will decrease because the income that I am getting has fallen, no madam. See, whenever I am putting my money with the banks, I have deposited my money with the banks. The reason I deposit the money with the banks was I was getting some return. Now, when the rate of interest has fallen, what is happening to my interest income? That also decreased. When my interest income is decreasing, what will happen to my spending? That will also decrease. So this will result in a reduction in the economic activity. So do you see here what is happening? Here you saw an expansionary monetary policy. Here what are you seeing? You see a contractionary monetary policy. So these both are working in the opposite directions. These both are working in the opposite direction. They'll ask you in the exam. Like saving and investment channel, cash flow channel work in dash direction. They work in opposite direction. Because in saving and investment channel, you saw increase in spending. In cash flow channel, you saw decrease in spending. Next, if the rate of interest on loans is reduced, what will happen? Let us see. Interest payments on debt will increase. So what is happening here? Interest rates, if the interest rate on loans are reduced by the central bank, so interest payments on debt will increase. Cash availability with the households and businesses increase. Next, so this is not increase, it is actually decrease. Okay, so whenever your loan rate of interest on the loans has fallen, what will happen to the debt burden? That will decrease because you don't have to pay more interest payment right now because the rate of interest has fallen. So what will happen to the cash availability? That will increase. So what will happen to the spending on goods and services? That will also increase. Clear, everybody? So what did you see here? If the rate of interest on loans is falling, your repayment amount will also fall. So you have more amount of cash available with you right now to spend. So what will happen to the spending on goods and services? That will also increase. Next, let us talk about something called as asset price channel. So lower interest rate on loans. People, what will happen when the interest rates on loans are very, very less? The present discounted value of the future income will increase. See, what happens here is when the interest rates on loans are really, really less, you borrow more amount of money. That is, you demand more assets. So when the demand for assets is increasing, what will happen to the price of assets? That will also increase. That is what they are talking in the asset price channel. That is what they are talking in the asset price channel. So what will happen here? Support asset prices by encouraging the demand for assets. Simple. See, whenever the loan, the rate of interest on loan is falling, so what is happening here? You are demanding more assets. So whenever you are demanding more assets, what will happen to the price of the assets? That is increasing. So it is giving you a feeling that you are more wealthy right now. As the asset price is increasing, you are feeling that you are more wealthier, right? So asset prices will increase. Collateral of an asset for banks to lend against will increase. Easier for households and businesses to borrow. So if your asset prices are increasing, so what will happen? You can actually pledge that asset and get more amount of money. An increase in the asset price increases people's wealth. See, whenever you see people spending, that not only depends on their current income, but also the amount of wealth they are holding. Okay, if the people feel that they are more wealthier, that is, if the prices of their fixed assets, they kind of increase or they kind of surge, they make people feel more wealthier and they also want to spend more now. Next, household consumption increase, housing investment will increase. So did you understand the logic here? Rate of interest on borrowing decrease. So demand for assets increase. Asset price increase. So if asset price is increasing, people are feeling wealthier. If people are feeling wealthier, the demand for goods and services and housing investment will also increase. Next, Let us discuss another channel, which is your exchange rate channel. So what is this exchange rate channel? It is for the exporting firms and import competing firms. The appreciation or depreciation of the currency, how does it affect our economic activity? So what is happening here? Let us understand one simple thing here, okay? So there is a rate of interest prevailing in our economy. There is a rate of interest prevailing in Indian economy, and there is a world rate of interest prevailing outside the Indian economy. For example, if the rate of interest prevailing in the Indian economy is less than the rate of interest prevailing in the world economy. So what did I tell you right now? The rate of interest prevailing in the Indian economy is less than the rate of interest prevailing in the world economy. That is what they have written. If RBI decreases the rate of interest in the Indian economy is less than the rate of interest in the world economy, right? So what will happen? Investors earning from assets in India will be less than what they are earning from assets in other countries. So whenever the rate of interest is decreasing, the investors will lose their interest to invest in the country, because now they are getting lesser amount of return. So what is happening? Why are they losing interest? When RBI reduces the rate of interest that is prevailing in the Indian economy is less than the rate of interest that is prevailing in the world economy. So investors, when they are investing somewhere, they will look at the rate of return, right? So they now feel that, hey, Baba, in India, the rate of interest is less, but in the world economy, the rate of interest is really, really high. So let me not invest in India. Let me actually invest somewhere else. Okay, so demand for assets in India as well as Indian rupees will decline. See, whenever the foreigners want to invest in India, they need to buy what? They need to buy rupees by exchanging their currency. For example, if an American wants to invest in India, he has got dollars with himself. What he will do? He will sell those dollars, buy rupees, and then invest in India. So then the demand for rupee was increasing because he is giving dollars and demanding rupee. Now, as people are not investing in India, what has happened to the demand for rupee? It has decreased. What has happened to the demand for rupee? It has decreased. Whenever the demand for rupee has decreased, what will happen to the value of the rupee? As nobody is demanding rupee, what will happen to the value of the rupee? That will also decrease. We call that as depreciation. We call that as depreciation. And whenever a currency depreciates, it is favorable for the exports and not favorable for the imports. So whenever a currency depreciates, it is favorable for the exports and not favorable for the imports. So let us see the points. So demand for assets in India as well as Indian rupee will decline. So this will lead to what? This will lead to the lower exchange rate or the Indian rupee depreciation. So what will happen? The Indian rupee will depreciate. So cheaper exports, costlier imports. See, any country wants to enhance its exports and reduce the level of imports. That is when it is profitable for it. See, exports means you're selling goods and services and earning revenue. That is Indian economic activity, or Indian goods are demanded. And whenever you are importing, you're actually spending your money on foreign goods. You are not generating Indian economic activity, you're generating the economic activity for somebody else. So how can it be profitable for your country? So whenever a currency is depreciating, what will happen to the exports? They will increase. What will happen to the imports? They will decrease, landing the country in a profitable situation. So costlier imports add to inflation in India. So let us understand what is this. Okay, costlier imports add to inflation in India. Let us understand this. Let us, split it and then understand. So what is happening when imports get expensive? When imports get expensive, one second. The demand for foreign goods will decrease. What will happen? The demand for foreign goods will decrease. And when the demand for foreign goods are decreasing, so what has happened here? The imports have become expensive. When the imports got so expensive, your Indians will not import, rather they will decrease the demand for foreign goods and increase the demand for Indian goods. Whenever there is an increase in demand for Indian goods, what will happen to the prices of the Indian goods? May I know? They will increase. So increase in demand for something will result in an increase in the price, right? So whenever the demand for Indian goods is increasing, what is happening to the price of the Indian goods? That is also increasing. So causing an inflation in the Indian economy, right? So what are the other channels? You have something called as the quantum channel and two credit channel. So what are your credit channel? One is the bank lending channel. The other is the balance sheet channel. See, whenever a bank is lending money to you, it kind of sees your assets and liabilities, right? Your balance sheet is nothing but a statement showing the assets and liabilities. So banks kind of see the weight of the assets and then provide you loans. So whenever the assets of a company are increasing, it is actually easy for it to borrow money, right? So that is one channel. Next, let us read the note point what they have written here. So if the interest rate increases, cost of borrowing for the households increase. So their consumption decrease. Yes, absolutely. So what is happening to the cost of capital? It will increase. So this is from a household point of view. This is from an investor point of view. When the cost of capital increases, their investment will decrease. Cost of capital is nothing but cost of borrowing. Their investments will decrease. So it is referred to as contractionary monetary policy. A fall in the interest rates is expansionary monetary policy. A rise in the interest rates is contractionary monetary policy. So students, will you memorize this? A fall in the interest rate is expansionary monetary policy. A rise in the interest rate is contractionary monetary policy. That's it. So the next thing that we have here is the operating framework. I told you, right? The day-to-day activities that you perform to achieve the monetary targets, that is nothing but your operating procedures. So let us read what they have given here. Operating framework of a monetary policy. Monetary policy implementation through choosing operating target, choosing intermediate target and choosing policy instruments. Listen to me carefully, students. You have got an objective. You have got an objective. For achieving those objectives, you set certain targets. For achieving those targets, you have certain instruments at the discretion of the Reserve Bank of India or the central bank of the country. So what is it? What is that I have told you? For any institution, for any central bank, there are a set of objectives. For achieving those objectives, you need to set some targets. Okay. For achieving those targets, you have got some instruments at the discretion of the central bank, right? So what are operating procedures? Day-to-day implementation of monetary policy by central banks through various instruments is referred to as operating procedures. So I told you, right, the RBI has got a set of qualitative instruments and quantitative instruments. It using those qualitative and quantitative instruments in the day-to-day activities to achieve their targets, in turn who will achieve the objective is nothing but the operating procedure. Next, what are your monetary policy instruments? I told you there are two types of instruments. One is qualitative, the other is quantitative. One is qualitative, the other is quantitative. So the instruments are categorized into quantitative and qualitative tools, right? So let us read the quantitative tools first. So this is your lesson, people. In monetary policy, the most important part is you understanding what are the various quantitative tools available with the Reserve Bank of India. Clear, everybody? So have direct effect on the economy's entire money supply. Let us see how they are having a direct impact on the money supply. So the first thing that you can see here is the reserve ratio. See, whenever I say reserve ratio, it includes two things. One is your CRR, the other is your SLR. CRR is the cash reserve ratio. SLR is a statutory liquidity ratio. See, you being a scheduled commercial bank have to follow the rules that are set by the RBI. Now the RBI, what it does is it decides the reserve ratio. See, this reserve ratio indicates that whenever a bank is receiving deposits, it cannot lend out the entire deposits, but a portion of the deposits has to be maintained as reserves with the Reserve Bank of India. So I told you, right, there are two types of reserves. One is the cash reserve ratio, the other is your statutory liquidity ratio. Talking about your cash reserve ratio, currently the cash reserve ratio is 4%. The current cash reserve ratio is 4%. So whenever a bank is receiving deposits, for example, there is a bank called as A and it received a deposit of 100 rupees. Now, can it lend out the entire 100 rupees to the public? No, it can't. So in that 100 rupees, what it has to do is 4% it has to maintain with the Reserve Bank of India. That is 4% of 100 rupees has to be maintained with the Reserve Bank of India and it has to be not used for lending purposes. That is your cash reserve ratio. So what is your cash reserve ratio? The amount of deposits that a commercial bank has to maintain with the Reserve Bank of India. Next, What is your statutory liquidity ratio? See, statutory liquidity ratio is maintained with the commercial banks with themselves. That is, the current statutory liquidity ratio is 18%. So what is the statutory liquidity ratio means? See, some portion of the deposits have to be maintained in terms of liquid assets. That is, they have to be maintained in terms of cash, in terms of gold, and in terms of government securities. So what is that I have told you? Statutory liquidity ratio indicates that some portion of the deposits has not to, they should not be lent. Okay, I'm so sorry. Some portion of the deposits, they should not be lent and they have to be maintained as statutory liquidity ratio. And what is the current statutory liquidity ratio? It is 18%. So 18% of the deposits have to be maintained in terms of cash, in terms of gold, and in terms of government securities. So let us see this. Banks require to set aside some portion in cash with the Reserve Bank of India, which is nothing but your cash reserve ratio, and the current CRR is 4%. Fraction of the total net demand and time liabilities. So let us understand what is this net demand and time liabilities. See students, the meaning of net is nothing but receipts minus payments. What is the meaning of net? It is receipts minus payments, right? So whenever I am saying net demand and time liabilities, see, whenever a bank is receiving deposits, it has got a demand liability portion and a time liability portion. So what is this demand liability portion? For example, I went to the bank and I made a demand deposit. So what do you mean by demand deposit? Whenever I go to the bank and I ask for my money, the bank has to repay that money back to me. So that is the demand liability portion of the bank. Whatever deposits we are putting with the commercial banks, they are a liability for the commercial bank. They are an asset for us, right? So this is the demand liability portion. All the demand deposits are your demand liability portion. All your time deposits, that is after a specific period of time, after a maturity period, I go and ask my funds back. Before that, I cannot do that, right? So this is the time liability portion. That is, I'm giving the commercial bank some period of time, right? So a bank has demand liability portion and time liability portion. Now, what is the meaning of net? I told you, right? Receipts minus payment. So deducting demand liability, time liability minus interbank deposit. What is it? Demand liability minus demand liability, time liability minus interbank deposit. Okay. So what do you mean by interbank deposits? See, suppose let us take the example of the State Bank of India and the ICICI Bank. Okay. So whenever I have a transaction with a person, let us say I am person A. Person A is having a transaction with person B. Person A is having a transaction with person B. Person A has an account in SBI. That is, I have an account in State Bank of India. And person B has an account in ICICI Bank. Okay. So whenever A and B are transacting with each other, SBI and ICI are transacting with each other. So when these both have to transact with each other, they need to have an account with each other. That is, SBI maintains an account with ICICI. ICICI maintains an account with SBI, right? So whenever they are having an account with each other, they are holding deposits also. This is called as interbank deposit. This is called as interbank deposit. Okay. So demand liability, time liability portion minus interbank deposits will give you your net demand time liability. And whenever you are maintaining your CRR and SLR, they have to be maintained as a percentage of the net demand and time liability portion. Clear, everybody? Sir. So students, what is net demand time liabilities? It is demand and time liability portion minus the interbank deposits, right? So whatever cash reserve ratio that we are maintaining with the Reserve Bank of India has to be maintained as a percentage of the net demand and time liability. So let us start our discussion again with SLR. So what have they written here for SLR? It is nothing but banks are required to set aside this portion as a percentage of the net demand time liabilities. What is the current SLR rate, students? It is 18%. So this 18% have to be maintained in terms of liquid assets, and that liquid assets can be in terms of cash, gold, and government securities, right? So banks are allowed to earn interest on these securities. However, it is very, very low. So what did we learn? That in the liquid assets, you can maintain in terms of cash, gold and government securities, right? When compared to other risky investments, the yield on government securities is comparatively low. Next, let us go to the other instrument, which is your open market operations. The open market operation is nothing but the sale and purchase of government securities by the Reserve Bank of India, which kind of regulates the money supply in the economy. So let us understand how the sale and purchase of government securities is regulating the money supply. So first of all, understand what are these government securities. You keep hearing the term treasury bills, government bonds, right? So whenever you are talking about short-term instruments, it is treasury bills. Long-term, it's government bonds. Whenever the government is in requirement of funds, it borrows money from the public, right? Next, so to control money supply, the RBI buys and sells government securities in the open market with an objective to adjust rupee liquidity conditions in the market. So how that is done, let us have a look. So whenever RBI feels that there is lot of money supply in the economy causing inflation in the economy, students always remember there is a direct relationship between money supply and the general price level. So whenever the RBI feels that there is excess money in the economy causing inflation in the economy, it tries to suck out that excess money. And how does it suck out that excess money? It releases government securities in the economy. It makes people purchase those government securities. So the money from the people will go to the government. The money from the people will go to the government. So RBI sells government security, liquidity is sucked out from the market, inflation gets controlled. See, whatever inflation that you have seen, that was seen because of the rise in the money supply. It was seen due to excess money supply. If that excess money supply can be reduced, inflation can be brought into control, right? Next, RBI buys government securities. When does RBI buy government securities? See, whenever RBI is purchasing government securities, it is releasing money supply into the economy. So whenever RBI feels that there is, recession happening or there is a fall in the economic activity, there is a need for injection of money supply into the economy to, increase the economic activity, RBI resorts to buying of government securities. That is, RBI gives cash or releases money supply and gets government securities, right? Next, OMO affects short-term interest rates, in turn affects the long-term interest rates economic activity. Okay, let me just tell you about something which is called as Operation Twist. So let me just open the notepad here. So in this, we are going to see how a short-term interest rate can affect the long-term interest rates. Clear, everybody? So what RBI does is, let me open a section for you. No, this not okay. Yeah. So what RBI does it sells short-term government securities. What RBI does, it sells short-term government securities. Whenever it sells short-term government securities, what happens to the supply of the government securities? It will increase. When the supply of the government securities increase, what will happen to the price of the government securities? It will decrease. And what will happen to the rate of interest? That will increase. Okay, everybody? Now, when it sells the short-term government securities, what is it receiving? It is receiving money from the sale of short-term government securities. Whatever sale proceeds that has received from the sale of short-term government securities is used in the purchase of long-term government securities, long-term government securities. So, whenever RBI purchases long-term government securities, the demand will increase. Whenever the demand will increase, what will happen to the price? That will increase. What will happen to the price? That will increase. Whenever the price of the government securities increases, the rate of interest will decrease. See, one key thing that you students have to understand here is the relationship between bond price and bond yield have an inverse relation. The relationship between bond price and bond yield have an inverse relationship. Clear, everybody? So this thing, whatever we have done here, is called as Operation Twist. That is, by selling your short-term government securities, by acquiring the proceeds of short-term government securities. Those proceeds have been used to purchase the long-term government securities, which has reduced the rate of interest, right? So whenever the long-term rate of interest is decreasing, more people will be willing to borrow money and more economic activity can be generated. So this is how you are using short-term government securities to influence the interest rates in the long term. I hope you understood. Yes. So let us proceed to the next one. The different policy rates under market stabilization scheme. See, what is the meaning of market stabilization scheme? The name itself suggests that it is nothing but you're trying to stabilize the prices or stabilize the economy when there is excess money supply. You're kind of cleaning the economy when there is excess money supply. So this market stabilization scheme, it is actually an agreement between Government of India and the Reserve Bank of India to maintain stability in the economy. So let us see what is happening here. Under market stabilization scheme, the Government of India borrows from the Reserve Bank of India, such borrowing being additional to the normal borrowing. People, please do remember that whatever borrowing that is done by the Government of India under the market stabilization scheme is not a normal borrowing. It is not a normal borrowing. This is done only to stabilize the economy, only to suck out the excess money from the economy. That's it. Okay. I'm repeating this again. Market stabilization scheme, whenever the government is borrowing money, that is by issuing the bonds, whatever borrowing is coming under MSS is not normal borrowing. It is addition to the normal borrowing. And this is solely done for what? This is done to stabilize the economy. Yes, and issues treasury bills or dated securities, right? So what is this liquidity adjustment facilities? Let us just understand this. Okay, let me take a small example. So there is a bank A and there is a bank B. There is bank A and there is bank B. Okay, bank A received 100 rupees of deposits. Bank B also received 100 rupees of deposits. Okay, so as per the RBI regulations, you being a scheduled commercial bank, you need to maintain some portion of your deposits as reserves. That is, you should not lend that to anybody else, right? So you maintained some, let us say 22 rupees as reserves. Now you are having 78 rupees that is available to lend to the people. The same goes for bank B. It is having 78 rupees to lend to the people. Now what happened here? Bank A has lent how much amount? It has lent some 48 rupees. It has lent some 48 rupees and it is having an excess of 30 rupees. Bank A has lent how much? It has lent 48 rupees and it is left with a surplus of 30 rupees. Bank B, the demand for loans is 108 rupees. So it is in a deficit of 30 rupees. Okay. So now bank A has a surplus of 30. Bank B has a deficit of 30. So what bank B can do, it can go to bank A and ask, as you're in a surplus of 30, can you lend me this 30? Bank A will agree, but as they are competitors, Bank A may actually exploit Bank B by charging a very, very high rate of interest. So what RBI has done was, it has introduced this liquidity adjustment facilities. That is, whenever banks are facing with the shortage of funds, they can avail the liquidity adjustment facility. Whenever banks are facing shortage of funds, to avoid exploitation, they have introduced something called as liquidity adjustment facility. So bank B, instead of borrowing from bank A at a very, very high rate of interest, it can actually borrow from the Reserve Bank of India to adjust its short-term obligation. Clear, everybody? So let us see the point here. So liquidity adjustment facility, on the basis of the recommendations of the Narasimhan Committee on the banking sector reforms, the RBI introduced something called as liquidity adjustment facility for financial accommodation to central banks. What do you mean by financial accommodation? That is, whenever the banks are in short of money, they will be borrowing from the Reserve Bank of India through repo and reverse repo. So let us understand what is this repo rate. See, in simple terms, repo rate is nothing but the rate at which the commercial banks borrow from the Reserve Bank of India. What is repo rate? It is the rate at which the commercial banks borrow from the Reserve Bank of India. And whenever Reserve Bank of India is giving money to the commercial bank, or rather when the Reserve Bank of India is lending to the commercial banks, it needs some collateral, that it will ask for some security. Even though they are commercial banks, some security is required, right? So whatever government securities that the commercial banks are maintaining, a part of the SLR. See, I'm not talking about the SLR securities. In SLR, the banks need to maintain some portion as government securities, right? I'm not talking about that portion. So they maintain, barring your SLR, the banks maintain some government securities. So these government securities are pledged with the RBI and they are taking the loan. So this repo meaning is repurchase. Repo meaning is repurchase. So what are the commercial banks repurchasing? So they promise the Reserve Bank of India that whatever securities that they are pledging with the bank, they are going to repurchase those government securities on a future date. And whenever I am saying repo, it is for short term purpose. Whenever I am saying repo, it is for short term purpose. Clear, everybody? So repo is for short term borrowing. So let us see the point. Banks borrow from the Reserve Bank of India on short-term basis against the repurchase agreement. So what are they repurchasing? They are going to repurchase the government securities, whatever they have pledged with the RBI. Next, the rate charged by the RBI for this transaction is called as repo rate. So repo is nothing but the rate at which the commercial banks are borrowing from the Reserve Bank of India. Monetary policy uses repo rate as one of the significant tools to control money supply. Okay, people. So repo is used for short-term operations. Repo is used for short-term operations. And you also have something called as overnight purpose. Okay, overnight lending is also done. For that overnight lending, whatever rate is decided, it is called the policy rate. For overnight lending, whatever rate is decided, that is called the policy rate. Okay, fine. So you have call and you have term borrowing. Okay, call borrowing, term borrowing, which we have discussed in your money supply. Call means 24 hours. Term more than 24 hours. So overnight, whenever you are talking about overnight borrowings, it is called as what? It is your, the rate that is decided for overnight borrowing is your policy rate. Next, reverse repo rate. So this is ulta. So repo rate is nothing but commercial banks are borrowing from the Reserve Bank of India. Under reverse repo rate, the Reserve Bank of India actually borrows money from the commercial banks. That is, whenever the commercial banks are having excess money, they put their excess money with the Reserve Bank of India and in turn earn some rate of interest. They in turn earn some rate of interest. So what is happening here? The Reserve Bank of India is actually taking money from the commercial banks. See, when commercial banks are borrowing from the Reserve Bank of India, they did pledge government securities. Now, the same rule applies for the Reserve Bank of India as well. Even Reserve Bank of India is taking money from the commercial banks, right? So it also has to put some government securities as security, right? So the government securities are put with the commercial banks and money is taken by the Reserve Bank of India from the commercial banks. See, repo is a way of injecting liquidity into the economy. Reverse repo is a way of, sucking out the liquidity from the economy. So when banks are depositing their surplus money with the Reserve Bank of India, the money supply will kind of decrease because these excess reserves, which they could have used for lending purpose, they are actually giving it to the Reserve Bank of India. It is the reverse repo rate, that is the rate RBI pays to the banks to keep additional funds in the RBI. So currently the reverse repo rate is around 3.35%. So what do you have to observe here is that you always have to remember that reverse repo rate is always less than the repo rate. The reverse repo rate is always less than the repo rate. What is the reason why the reverse repo rate is always less than the repo rate? People, if the reverse repo rate is greater than the repo rate, will the banks actually lend money to the people? They will feel that, reverse repo rate is greater than the repo rate. So let me just put all the funds with the RBI. My funds are safe with the RBI and I'm going to get some return. Why should I even take the risk of doing this banking business? So they will get a thought like that. So your reverse repo rate is always less than your repo rate, right? So there is a formula for your reverse repo rate. But right now, it is not, the difference is not 100 basis points actually, it is more than that. But the definition that they have given you from the beginning, this has been coming. So you need to remember this. So your reverse repo rate is repo rate minus 1. The current repo rate is 6.5% student. Reverse repo is around 3.35%. As you can see, the difference is not 1 actually. But the definition is, the formula for that is reverse repo is equal to repo minus 1. The standard formula is that. Next, we have already discussed policy rate. So what is the meaning of policy rate? In India, the fixed repo rate quoted for sovereign securities overnight segment. So whenever you are lending on overnight basis, the rate whatever you are quoting for overnight basis is called as your what? Policy rate. Next, let us talk about margin standing facility. So this has been recently introduced. The reason that they have introduced this marginal standing facility was, see, whenever you have to borrow money using repo rate, what you need to have? You need to have government securities, like you need to have surplus government securities. For example, your bank is not having government securities, but it is in dire requirement of funds. Now, what can it do? Now, it has no government securities, so it cannot borrow using repo rate, but it wants funds so badly. So what RBI has told was, okay, as you require funds so badly, you can actually dip inside your SLR. In SLR, you maintain some government securities, right? Those government securities you can use and you can borrow from the Reserve Bank of India. But there is something that has happened here. You violated the SLR requirement. What did you do here? You violated the SLR requirement. For that, you have to be punished. So under MSF, whatever rate that we are charging is always greater than the repo rate. And the formula is MSF rate is equal to repo rate plus 1. The formula is repo rate plus 1. What happened here actually? Under repo rate, if you want to borrow, you need to have government securities. But you don't have government securities, but you still require funds. But under SLR, you are maintaining some government securities, right? See, technically speaking, they should not be used for borrowing purpose. They are set aside as reserves as per the RBI mandate, and they have to be maintained that way. But you require funds so badly that the RBI has given you permission to dip inside your SLR and use 1%. It is not that you use all your government securities. You can use still 1% of your SLR securities and you can borrow from the Reserve Bank of India. But you violated the SLR requirement. For that very reason, you will be charged a penal rate. That is, the rate is more than the repo rate. So MSF rate is the penal rate at which RBI lends money to the banks over the rate available under the repo policy. So MSF is the scheduled commercial banks can borrow additional overnight money from the Reserve Bank of India over and what is available through the LAF window, that is the liquidity adjustment facility window, by dipping into the SLR portfolio limit. That is, by dipping inside your statutory liquidity ratio, you can actually use that money and then you can borrow. Banks availing MSF rate can use maximum of how much? It is 1% of the SLR securities. So what is the formula for MSF rate? MSF is equal to repo rate plus 1. What is the formula for MSF rate? MSF rate is equal to repo rate plus 1. So let us discuss something called the bank rate. See, repo is for short-term obligations, right? Bank rate is used for long-term lending. So bank rate is used for long-term purpose. Okay. So bank rate is also called as discount rate. So here what the commercial banks can do is, whenever they are having bills of exchange, they can rediscount them with the Reserve Bank of India and they can get money from the Reserve Bank of India. So under bank rate, what is happening? It is a long-term rate. It is also called as discount rate, right? So whenever commercial banks are having bills of exchange, they rediscount them with the Reserve Bank of India and they can get money against that, right? So let us see this. But recent times, bank rate is not so much in use. Actually, with the introduction of liquidity adjustment facility and with the introduction of marginal standing facility, bank rate has actually lost its relevance. So it is the standard rate at which RBI is prepared to buy or rediscount the bills of exchange or other commercial paper eligible for purchase under the Act. Now RBI does not entirely control money supply through bank rate, as bank rate has been discontinued with the introduction of liquidity adjustment facilities. So bank rate, is it still in use right now? Not really. Next, bank rate is used to penalize the bank if it does not maintain CRR or SLR. See, You being a scheduled commercial bank, it is a mandate that you maintain the CRR and SLR that is decided by the Reserve Bank of India. Now, there are chances that you may not maintain CRR and SLR. If you don't maintain CRR and SLR, you need to be penalized for that. And the penal rate that is decided is your bank rate. And generally, your bank rate is equal to MSF rate right now. So, the penalty that banks have to, face is equivalent to the MSF rate. As bank rate is not really there right now, this is equivalent to your MSF rate. So, the penal rate is the highest rate in the LAF corridor. According to that, the banks are penalized. Next, let us read the conclusion. All the instruments of monetary policy, what did we study till now? We studied your CRR, SLR, repo, reverse repo, policy rate, bank rate, MSF rate. So they are inversely related to the money supply or credit supply. See, whatever rates that we have studied right now, if you see an increase in these rates, what will happen to the money supply? You will see a decrease in the money supply. So whenever your CRR, SLR, repo, reverse repo are increasing, that leads to a decrease in the money supply or credit supply. During inflation, so what is happening during inflation? Excess money supply, right? You need to suck out that. So you need to go for contractionary monetary policy. So what will you do? You will increase the reserve requirements. You will increase these repo, reverse repo rates so that this inflation can be tamed down. Right? During recession, what will you do? You will decrease them. During inflation, you will increase them. During recession, you will decrease them. Clear, everybody? So these were your quantitative tools. Now let us talk about your qualitative tools. Let us talk about your qualitative tools. See, qualitative tools are selective tools that affect the money supply on a specific sector of the economy. They don't affect the entire economy, but sector specific. These are morely sector specific. So let us talk about the first one, which is margin requirements. I'll make it really, really simple for you students. Let us understand the margin requirements with a simple example. So I'll just tell you a small statement. After that, I'll give an example for you. If the margin requirements are increasing, the amount of loan that you can take will decrease. If the margin requirement is increasing, the amount of loan that you can take is decreasing. I'll tell you the reason. One second. Yeah. For example, there is a land that you're owning and it costs 1 CR. The valuation of the land is 1 CR. Okay, 1 crore. Now, what you wanted to do was you wanted to pledge this land with the bank and you wanted to get money against it. You wanted to pledge this land with the bank and you wanted to get money against it. Okay, so let us see what happened here. And the margin required that was fixed by the RBI. The margin requirement that was fixed by the RBI, let us say it is how much? It is 60%. It is 60%. So, according to the margin requirement, now the margin requirement is 60%. So, you can only get a loan that is 40 lakhs. You pledged a land that is 1 crore, but you only got a loan that is 40 lakhs. So, increase in margin requirement will decrease the amount of loan that you can take. For example, the margin requirement is 90%. The margin requirement is 90%. So, what is the amount of loan that you can get? 10 lakhs. So, margin requirement tells you the amount of money you need to fund yourself. The amount of money that you need to fund yourself. Let us proceed. Next, let us discuss this moral suasion. It is very simple. You already have seen that government securities are issued by the what? Government of India, and the purchase and sale is taken care by the Reserve Bank of India. See, what RBI does it tries to encourage the commercial banks rather than investing in other assets. It tries to persuade the commercial banks to invest in government securities. So that is your moral suasion. You are actually wanting them, you are actually telling that, beta, in these two options, this is good. So please go for it. You are persuading them. You are leaving it to their discretion, but you're telling them what is right, what is wrong. It's like you're actually persuading them to do something. So, by way of persuasion, the RBI convinces the banks to keep money in government securities rather than certain sectors. So, what is the Reserve Bank of India asking the commercial banks? It is asking them to invest more in government securities. Next, selective credit control. See, under selective credit control, what RBI says is, it tells the banks not to lend to certain sectors, especially those involved in speculative business. Let us take the example of gambling, betting, something like that, lottery business. So it tells the commercial banks not to involve in such speculative activities, that is selective credit control. Clear, everybody? Yes. So this is your qualitative measures. So what are your three qualitative measures? They are your margin requirements, moral suasion, and selective credit controls. Clear? So the next topic is your organizational structure for monetary policy decisions in India. This is going to be a very simple topic. In this, we are going to discuss your MPC, the Monetary Policy Committee, how it has been constituted, the members in MPC. So what are the, how frequent your MPC meetings are held, all that we'll have a discussion. And in the last, you're only left with the Reserve Bank of India's monetary policy decision. So with this, we can complete our chapter. So we have actually come to an end. So have some more patience so that we can complete your chapter. Okay, students, so we were discussing about the organizational structure for monetary policy decisions in India, right? So I told you that we'll be talking about the Monetary Policy Committee, the composition of Monetary Policy Committee, the frequency with which the committee meets, all that we'll have a discussion. So with no delay, let us start the subject. Explains how monetary policy is conducted in India. So the organizational structure for monetary policy decisions, what does it explain? It explains how monetary policy is conducted in India. The RBI India Act, the Reserve Bank of India Act 1934 was amended. When was it amended? It was amended on 27/6/2016 for giving a statutory backing to the Monetary Policy Framework Agreement. But let us understand what is this Monetary Policy Framework Agreement first. So it is nothing but it is an agreement between Government of India and the Reserve Bank of India on the maximum tolerable inflation rate. So the Monetary Policy Framework Agreement is nothing but an agreement between the Reserve Bank of India and the Government of India stating the tolerable level of inflation. That is, the lower limit is 2%. The upper limit is 6%. The inflation should not rise above 6% and should not fall below 2%. Okay. Next. The RBI Act 2016 provides statutory basis for implementation of flexible inflation targeting. So what do you mean by flexible inflation targeting? In flexible inflation targeting, you will be given a band that is 2% to 6%. So I have given you a range within which you can stay. Right. So I have provided you the flexibility, that is you can vary between 2% to 6%. On an average, you have to remain at 4%. On January 2014, RBI abandoned the multiple indicator and made inflation targeting as primary objective. Like I have always told you, every institution is established with a set of objectives, right? Your Reserve Bank of India, which is the central bank of the country, is also established with an objective. Like it has in the earlier stages, it has many objectives in mind. But finally, that was called the multiple indicator approach. When the RBI had multiple objectives, it was called the multiple indicator approach. Now, what it has done was, it has told people that, dekho, my primary objective, or rather the important objective that I will focus on is my inflation targeting. Right? So that approach has been, the multiple indicator approach has been changed to the approach focusing on inflation targeting. Next, and this was done on whose suggestions? On the suggestions of expert committee under Urjit Patel. Next, the inflation targeting is set by the Government of India in consultation with the RBI. Like I told you, the agreement that is happening between RBI and the Government of India. So what they do is every 5 years, they decide the inflation target. Once in every 5 years, they decide the inflation target. So for 5/8/2016 to 31 March 2021, the target that was set was 4% should be the average inflation. I told you, right? So your inflation ranges from 2% to 6%. That is a tolerable level. On an average, what is the amount of CPI that must remain? It must be 4%. The Consumer Price Index, by the way, talks about retail inflation. The wholesale price index talks about the inflation at the manufacturer level, okay, the wholesale level. So what we are concerned about is the CPI. We are concerned about the end users, right? So our sole focus will be on your consumer price index, which talks about the retail inflation. Next, upper tolerance limit is 6%, lower tolerance limit is 2%. So RBI publishes monetary policy report every 6 months. So a monetary policy report is submitted every 6 months explaining the sources and forecasts of the inflation come for the coming 6 to 18 months. So every 6 months you submit a report and you kind of project the inflation for the coming 6 to 18 months. The central government constitutes as failure to achieve the inflation target when, see, your average inflation is what? It is nothing but the inflation, the upper level, the upper limit plus lower limit divided by 2. That is your average. If the average inflation is greater than the upper tolerance level, that is the prevailing inflation. Let us talk like this. That will make things easier for you. For example, the current CPI is around 8% or it is 7.9%, something like that. So as you can see that the 7.9% is greater than the upper tolerance limit that we have talked about. What is your upper tolerance limit? It is 6%. What is your lower tolerance limit? It is 2%. For example, if the CPI is 1.5%, it will be less than the lower tolerance limit. If it is 7 or 8%, it will be greater than the upper tolerance limit. So nothing can be, accepted. So average inflation greater than upper tolerance limit for any 3 consecutive quarters. One quarter is 3 months, right? So 3 consecutive quarters. If the RBI is unable to get the inflation back on track, that is, if it is not abiding by whatever target that they have set, the government kind of intervenes asking for reasons, right? The average inflation less than lower tolerance level for any 3 consecutive quarters. So government will consider that to be a failure by the Reserve Bank of India. Now what is your MPC? See, MPC kind of meets every 2 months and it decides the rates that have to prevail in the economy every 2 months. So bi-monthly we call that as. So MPC has 6 members, 3 members from the Reserve Bank of India, 3 members from the government of India. So what they do is every 2 months they meet up, have discussions with regard to what should be the repo rate, what should be the reverse repo rate, what should be the reserve ratios and all. So the current repo rate, recently the MPC had a meeting and they decided that they are not going to change the repo rate and keep it 6.5% like it was previously. I think from 4-5 meetings they have not been changing the repo rate. They are holding it at 6.5%. Next, it consists of 6 members to determine the policy rate and achieve the inflation target through debate and majority vote. So, when there are 6 members in the panel, they do the voting process, whether to change the repo rate or not to change the repo rate, whether to increase the repo rate or decrease the repo rate. For example, there are 4 people, there are like 3 people who said that the repo rate has to be increased and 3 people stated that repo rate has to remain constant. So there is a tie, right? So there is a tie. So you cannot figure out something. So what happens here is the RBI governor will be given an additional vote. The RBI governor will be given an additional vote. I told you, right? 3 people are from Government of India, 3 people are from Reserve Bank. One is the RBI governor himself and the deputy governor. Next. Let us discuss topic 6, which is Reserve Bank of India's monetary policy decision. So RBI uses monetary policy to manage the economic fluctuations and achieve price stability. So that is what we have been learning. So what is the role of RBI? It manages the monetary policy. What is the role of monetary policy? To attain stable inflation and economic growth in the economy. RBI conducts monetary policy by adjusting what? By adjusting the money supply, buying and selling of government securities in the open market. This buying and selling of government securities in the open market is called as open market operations. And the market where the government securities are dealt is called the gilt-edged market. The market where the government securities are dealt with is called the gilt-edged market. Next, with recent increasing openness of the Indian economy. What do you mean by openness of the Indian economy? See, we are actually a closed economy at the beginning of after the independence, but later on we started to open up, we started accepting investments, we kind of reduced the regulations. So we are accepting investment, private people are allowed to function. So in the beginning we actually followed, even though we called ourselves a mixed economy, our pattern was a socialistic pattern. Later we shifted and then now we are actually trying to explore more opportunities. So whenever India is called as an open economy, it indicates that we are trying to adapt to the changes that took place due to globalization. and progressive economic and financial sector reforms. Even financial stability and exchange rate stability have assumed great importance in India. Students, do remember that any economy can sustain if there is financial stability. So financial institutions, the banking and finance play a vital role for the development of any economy. And exchange rate stability. Your exchange rate needs to be stable. What is the exchange rate? It is one currency expressed in terms of other currency. For example, you keep saying that $1 is equal to 83 rupees. So you are expressing dollar in terms of rupee. It is nothing but price of the dollar. For you to acquire $1, how many rupees do you require? And there must always be exchange rate stability. So you cannot expect your exchange rate to fluctuate every other minute. Then people will lose confidence. It can be a huge threat to the investors. It can be a huge threat to the manufacturers, because not all the raw materials that they require for manufacturing will be made in the country itself. They need to get it from outside as well. And when they are getting things from outside the country, there involves something called as exchange rate. Next, when RBI lowers the interest rates, monetary policy is easing. See, the meaning of monetary policy is easing is you are going for an expansionary monetary policy. The meaning of monetary policy easing is you are going for expansionary monetary policy. The meaning of monetary policy tightening is you are going for contractionary monetary policy. I hope you understood the things. Now what we will do is we will try to address few questions. We will try to address few questions, so which will help you, gain more confidence with regard to the topic. We'll just solve few bits, and let me just see how much you have understood. So we'll start with this. So what is your first question? Which of the following is the function of the monetary policy? Regulate the exchange rate and keep it stable. Regulate the movement of credit in the corporate sector. Regulate the level of production and prices. Regulate the availability, cost and use of money and credit. See, all the three, they are not considered as functions, okay? So what is the function of monetary policy? You're trying to regulate the money supply. You're trying to regulate the amount of credit in the economy. You're trying to regulate the cost of credit. That is what the function is. So it is option D. What is it? Option D. Next. What is the main objective of monetary policy in India is? What is the main objective of monetary policy? Monetary policy. Reduce food shortages. This is not our objective. Economic growth with price stability. Okay, this seems right, but let us read other options as well. Overall monetary stability in the banking system. Reduction of poverty and unemployment. So what is the option, students? It is economic growth with price stability. See, this seems correct, okay? But this is the more wholesome option. See, in the exam, they don't ask you to choose the correct answer. They ask you to choose the best option. Clear, everybody? So, and you are not only talking about monetary stability in the banking system as such, you're talking about the entire economy, right? So, price stability in the entire economy and economic growth. Next. The monetary transmission mechanism refers to, what does it refer? How money gets circulated in different sectors of the economy post monetary policy. The ratio of nominal interest and real interest? No. The process or the channels through which the evolution of monetary aggregates affects the level of product and prices. So, when the RBI kind of takes any decision, how the decision is impacting the aggregate output, prices and the level of employments will depend on the basis of channels through which it is passing, right? So, what is the right option? It is option C. So, monetary transmission mechanism is nothing but the channels through which the evolution of monetary aggregates affects the level of product and prices. Next. A contractionary monetary policy induced increase in interest rates. Okay. Contractionary monetary policy is nothing but monetary tightening. That is, you are trying to reduce the amount of money supply prevailing in the economy. So, what happens whenever you are increasing the interest rates? See, whenever you are increasing the interest rates, the cost of borrowing is increasing and people are not willing to take more money or more loans. Increase the cost of capital, yes, and the real cost of borrowing for the firms, okay. Increases the cost of capital, real cost of borrowing for the firms and households. This is what I was talking about. Yes, this is right. I'm not telling this is wrong. But which is the most wholesome option? Which is the best option? It is option B, because it includes both firms and households. See, whenever there is increase in the interest rate, it causes increase in the cost of capital, not decrease in the cost of capital. So this is wrong. Has no interest rate effect? No, not at all. It is through interest rates that your monetary policy is trying to impact the economy. Next. So what is your next question? During deflation. See, the meaning of deflation is fall in the prices. So what is the meaning of deflation? Deflation, fall in the general price level. What is the meaning of inflation? Rise in the general price level. So what happens during deflation? The RBI reduces the CRR in order to enable banks to expand credit. See, deflation is the condition that you see during recession, okay, fall in the economic activity. So your approach should be expansionary monetary policy. And if you want to have an expansionary monetary policy, all the reserves that we talked about have to decrease. All the reserves that we talked about have to decrease. So if you are decreasing the amount of CRR, banks are able to lend more money to the people. That is, RBI reduces the CRR in order to enable the banks to expand credit and increase the supply of money available in the economy. This seems correct. Next, RBI increases the CRR. Blunder. RBI reduces the CRR. Yeah. And the banks to contract credit. No, they expand the credit. RBI reduces the CRR but increases the SLR. Wrong. Both the reserves, they have to decrease. See, you are decreasing CRR, you are increasing SLR. What impact? It is negated, right? Positive, negative, mash. Next. Which of the following statements is correct? So, which of the following statements is correct? Students, please read the options. The governor of RBI, in consultation with the Ministry of Finance, decides the policy rate and implements the same. Okay. He decides it with the government of India. While the CRR has to be maintained by the banks as cash with the RBI, SLR requires holding approved assets by the banks with itself, right? So this is the correct option. So this is not just one ministry. The governor of RBI, in consultation with the Ministry of Finance, decides the policy rate and implements the same. This is the government of India. Okay, so you need to have government of India here. And next, this option seems right. Just have a reading. While CRR, this is not white, while CRR has to be maintained by the banks as cash with the RBI, true that. SLR means what? You are maintaining liquid assets. They may be in gold, they may be in cash, or they may be in government securities. So when repo rate increases, it means that banks can now borrow through. No, this is buying and selling of government securities. This is completely wrong. Not none of the above. So the correct option is option B. Next, RBI provides financial accommodations to commercial banks through reverse repo and repo under which scheme? You have to tell me this. It is liquidity adjustment facility. What is it? Liquidity adjustment facility, right? Next, is a money market instrument which enables collateralized short-term borrowing. Short-term borrowing, underline this, and lending. This is not tending, it is lending through sale or purchase operations. What is that called? It is called as the repo. Repo is nothing but repurchase option, right? So we discussed about this, the rate at which the commercial banks borrow from the Reserve Bank of India. Next, in India, the term policy rate. See, policy rate is used for overnight lending rate. So let us see where you can find that. The bank rate prescribed by the RBI in its half-year monetary policy statement. The CRR, SLR prescribed by the RBI, no. The fixed repo rate quoted for sovereign securities in the overnight segment. So this is your right option, right? So this is your MSF. This is not your related to your policy rate. Next, reverse repo operation takes place when? So in reverse repo, your RBI is taking money from the commercial bank. RBI borrows money from banks by giving them securities. This is correct, but let us see other options. Banks borrow money, no. Banks borrow money, no. RBI borrows money from central government, no. It is option A. So I hope you enjoyed the session. You were able to solve the bits. So what I request is you have to keep revising the things in your economics for finance. Otherwise, it will be of no help. But students, don't get scared of the subject. It is a very easy subject. You understanding the logic in economics for finance is really, really important. So happy learning. I'll see you in the next session.